All right.
I had one sitting at mine. I go behind the screen. Go back there.
So at this point, I'd like to call to order the Board of Administration meeting for Friday, May 12th, 2017. First of all, we have a quorum. We have, I think, for the first time in a long time, every seat filled,
Except one,
except one.
Bill Hayner.
Oh, Bill's not here.
Bill is out, and
All righty.
George may be on the way.
Still, a record attendance for a while, so thanks everyone for being here. So let's start with non-agenda public comment. Mark?
Two quick things. First of all, we have a few new trustees. George Kenny is not here yet this morning, but we have Mike McBride sitting over here as our new fire representative, who was at a first committee meeting yesterday, and then Bobby Spoon next to me was also appointed by the mayor, and this is her first board meeting, so welcome, Bobby, glad to have you here. Val has assigned Bobby to be on the audit committee, so her first committee meeting will be in July. So welcome to our new trustees. And then second, we have a returning trustee here this morning that I wanted to briefly acknowledge, and that's Alan Arolato. As you all know, Alan served on our board for 8 years, a long time. During that time, he was here through some of the craziest stuff that our retirement systems ever had to handle, including 2 major lawsuits with PSC litigation and our substantially equal lawsuit. We had a lot of very difficult issues that Alan participated in. And boy, I suspect that there's no one that's better exemplifies having gotten through the learning curve than Alan. He's has an amazing command of the pension issues that we face on a daily basis. Staff love working with him. Alan was disability committee chair for a number of years. He was board chair for a couple years. And we just very much appreciate your work, Alan. We have a plaque, as you know. I showed this thing to you recently, but I took it back because I wanted to read it into the record again today. And it says, the Board of Administration of the San Diego City Employees Retirement System hereby expresses its appreciation to Alan Arolato for your advice, collegiality, commitment, and service to the Board of Administration, staff, and SDCERS members, retirees, and beneficiaries. So thank you, Alan. It's signed by your cohorts up here. And I just want to bring you up and get a picture taken so that we can splash it on our website.
No photo bombing tonight.
No photo bomber.
I can say photo He'll do the rabbit ears.
If I was any closer, I'd goose you.
Thank you, Mark. Thank you, fellow board members. I tell you, it was an amazing 8 years when I came into this board in 2009, at basically the peak of the Great Recession, right? And pensions were the blame for everything, it seemed at the time. And we had CEO and David Wesco, who was an amazing leader at the time, and I think was great for that time. But then we brought Mark on the board as the CEO when David left, and very well filled David's shoes and led this board and guided us. My service to the board, while most people don't realize this, is uncompensated, except for a handful of free lunches every now and then, was personally enriching in ways that I never knew I would be enriched when I came on this board. I lived a life in the fire station. I lived a life riding a fire engine and didn't realize how big the world was outside the firehouse. When I came here and got to sit with my colleagues on the board and learn from them, it was amazing how much I didn't know in the world that I came from. And so as I spent my 8 years here, what I learned about pensions, what I learned about fiduciary duty, what I learned about pension politics, what I learned about actuarial science, which many of you know that was always kind of one of my favorites. It's been an amazing ride for me. I don't regret any of my time here. Some very difficult decisions over those years, but I can tell you that this board has made nothing but outstanding decisions. Not all of them I agreed with, but in the end, we always came to the right position on every issue. So thank you to my board members. Thank you for tolerating me on some of my rants every now and then. And and I'm sure you guys will continue to do good work without me. So thank you.
Alan, I just want to say thank you because some of those rants were between you and me, and I've got to say that it was a pleasure to serve with you, and you did a terrific job, always fulfilling your duty as a fiduciary to the board and to the members.
Thank you, Val.
Thank you. All right. That brings us to the administration of the oath of office.
Yes, Sheila Beal from the city clerk's office is here. I had forgotten the fact that when you're a newly elected trustee, you immediately go to the city clerk's office to get sworn in. But when you volunteer to be reappointed for a second term or are reelected for a second term, we need to have you do the oath of office one more time. So Sheila's here to do that for Thanasi, for Val, and for Carol. So I don't know if you want to do them one at a time, but if you guys could all step. You could stand right up here.
In front to stand?
Come on.
You're afraid to show those blue jeans, aren't you? It's actually the lacy underwear that's the problem.
Oh, thank you so much. Okay, all
Wait,
right.
hang your, hold on to your
Again, good
headphones.
morning. My name is Sheila Beal. I am, can you hear me? Yeah, I think it's working. Okay, good morning. My name is Sheila Beal. I am the Deputy Director of Archives and Records Management with the City Clerk's Office, and I am filling in for our City Clerk, Liz Malin. And it's a pleasure to administer your oath this morning. So, ladies and gentlemen, in accordance with the laws of the State of California and Charter of San Diego, it is my pleasure to administer your oath of office. Please raise your right hand and repeat after me. I state your name. Do solemnly swear that I will support and defend the Constitution of the United States and the Constitution of the State of California against all enemies, foreign and domestic, that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the State of California, that I take this obligation freely without any mental reservation or purpose of evasion, and that I will well and faithfully discharge the duties upon which I am about to enter. Congratulations, ladies and gentlemen. The City of San Diego wishes you the best of luck in carrying out your duties and responsibilities. Thank you. Welcome.
Thank you, Sheila.
Not yet.
All right. That brings us to item 5 on the agenda, approval of consent items A through D. I think we need to pull, do we pull anything out of here? No. So do we need a second on this?
Yep.
Okay,
You
so,
have one.
so I've made the motion and Jeff Wallace has seconded the motion to approve consent items A through D.
Ready to vote? All votes are in.
All right, that's unanimously passed. And that brings us to service, no, A through D. We're on item 6, consideration and action of items pulled from consent. We have none of those, so we're on to audit committee. We do not have an audit committee report, so we're on to investments. We're going to call investments out of order.
Yes, we are.
All right. So,
We're going to do all of investments, that's correct.
yeah, we're going to do the whole,
Okay, so I sat in for Bill Hayner as Chair of Investment Committee, and the first item on our agenda is a presentation by our lead general consultant, Steve Voss of Aon Hewitt. looking at the projected 30-year returns for the various, various asset classes. This is a very important analysis that informs our expected returns and potentially our discount rate. And also, as part of this item, which we need to vote on, will be the asset allocation recommendation. The asset allocation also is looked at annually. It's a primary driver of long-term investment success. It's not something we change very often, but it's a very important part of our investment program. Steve.
Great, thank you. Thank you very much. And hello and welcome to the new board members. I look forward to getting to know you and working with you in the quarters and years ahead. You're part of a pretty remarkable investment program and a pretty remarkable organization. We had a good, long, healthy dialogue yesterday about asset allocation and investment program structure. And I'm going to spend some time reviewing those things today. Try to keep my remarks to about 20 minutes. Do ask questions as they come along. Your investment committee was very engaged yesterday, and I would expect the same would be true here today too. So let's go ahead and get started and look at some of the key items that we're going to be talking about. So once every 3 years, we do a deep dive and we do an asset liability study. We partner with your actuary. We obtain the benefit payment information. We obtain the contribution information, work with your actuary, and then illustrate simulations over time on how we think those liabilities are going to change, how we think your assets are going to change in different economic environments, different interest rate environments, if stocks do well, if stocks do poorly, et cetera. We're trying to stress test your investment program and come up with the right mix between return-seeking assets and risk-reducing assets. That's done every 3 years. We presented in front of you a year ago at this time. We didn't do an asset liability study this last go-around. What we did is look at the asset allocation, the 78% in return-seeking assets and the 22% in risk-mitigating assets. And we wanted to say, is there any refinements that need to happen between those mixes that we might be able to exploit in the marketplace, add value, diversify, or reduce costs? So that's the lens at which we look at those things. So today we're going to talk about that 78-22. We're also going to talk about the structure, how we get that 78% in return-seeking assets. How much in private equity, how much in real estate, how much in international stocks, emerging markets, and so on and so forth. That happens also on an annual basis with your investment committee, but it truly happens on an ongoing basis with your investment consultant, Ann Hewitt, me and my team, working with your investment team, Liza and her group. That's an ongoing discussion as we're trying to refine and make changes to the investment program as needed. So very high-level overview. Why is asset allocation important? Asset allocation, we think, is the single most important decision that an investment board makes, or this board makes. It drives the long-term success, we hope, of your investment program. It is the number one driver of investment returns over time. There's studies that show that upwards of 90% or more of your future returns will be explained by asset allocation. Not so much by managers, not so much by structure, but by asset allocation. So it's important that we get it right. We're recommending that you continue to maintain that 78% return-seeking mix and 22% risk-mitigating mix. We've looked at things like the fact that the plan is closed for city employees. We looked at the fact that your liquidity profile, because it's closed, will be changing over time, but we don't think you need to take any action in the next, say, 3 to 7, possibly even longer than 10 years due to the nature of your investment program. We'll get into that in a little bit more detail. That 78-22 is needed to generate expected returns that can help you defease your liability over time. Your actuarial gives you an assumed rate of return that you need of 7%. I'm going to show you that that's going to be very hard to get to on a go-forward basis. You've achieved that over the last 3, 5, and 10 years. Returns have been quite good. Going forward, we think it's going to be difficult. We've spent a lot of time with your investment committee talking about that. Returns alone won't do it. We recognize that. And so the actuarial determined contribution is a critical component as well. Remember, the formula is fairly simple. Benefit payments equal investment returns plus contributions. If there's anything that you remember or take away from the time today, that's probably the most important thing that I could stress to you, that benefit payments equal investment plus contributions. When we look back at your investment program or other public pension funds over time, what we have seen is that investments have been the driver of that. If there were a pie chart that would illustrate how much of your total benefit corpus was related to investments versus contributions, investments was about 2/3 to maybe 75%, and contributions were the rest. That dynamic is changing because the expected returns on a go-forward basis are very different than the returns that the markets generated in the 1980s and the 1990s. Those were fantastic periods of time. Sadly, they're gone. And looking ahead, we think it's going to be quite a challenge to generate these returns. Some very high-level takeaway. There's 6 key items here, these considerations: diversification, downside protection. I'll try to be careful on my jargon, but we have the expression alpha. That means value added on top of a market return. So if the S&P returns 5%, we want our active managers to generate alpha on top of that of, say, 1 or 2%. So that's what alpha means. Inflation protection is an also important consideration. Flexibility. We don't want to be dogmatic and tied too closely to things that we may want to be more opportunistic in how we get exposure. We'll talk about that in liquidity. These 6 items were the lenses at which we look through asset allocation, in which we look at structure to make sure that we're making good decisions, prudent decisions that will help us add value to the investment program over time. Let's move ahead. And if I'm going too fast, please do pause. And if there's something that you saw in the materials, if you were able to review in advance that I skip, let me know, and I'm happy to go into deeper detail on any of those items. I do want to be respectful of your time. Okay, so this is your asset allocation as it exists today. And again, we're not making recommendations. The investment program totals $7.2 billion. A very nice size, large pool of assets that gives us the ability to get access to different types of investments and diversify on a global basis. Look at the items at the top. Those are our return-seeking assets. I'm looking at the table on the right-hand side. U.S. equity, non-U.S. equity, global equities. These are the things that should be generating returns and driving performance of the fund, helping us get close to that 7%. Below the dark line where it says U.S. fixed income or total risk mitigating assets, these are our conservative assets. They're the anchor for when things go bad. We do know that there will be bad times in capital markets. We've just experienced a very good 5-year period of time, but it wasn't long ago when we were going through 2008 and 2009 when we had significant drawdowns in the investment program. A couple things to note here. When the board and when the investment committee considers asset allocation and the board sets and approves asset allocation, we can't get there instantly. We have to move methodically over time, in particular as it relates to illiquid investments. So things like real estate shown halfway on that table, 9% current allocation. Our long-term policy that you all have approved is 11%. We will get there over time. We are methodically making new investments in real estate and other such areas. There's another line item here that we'll spend a little bit more time on, and that's the Opportunity Fund. The Opportunity Fund has a range, unlike all the other asset classes that have targets. It has a range of 0 to 8%. We commit capital to the Opportunity Fund when we see things that are unusual, that are a dislocation in the marketplace, and that we want to emphasize in the investment program. Right now, we're at roughly 3% of total. We made some commitments yesterday that you'll be talking about later this morning. Our ceiling there is 8%. And again, we'll talk a little bit more about that on the pages ahead. So I won't go through all these, but I think this is a table that's usually very useful for some of the newer trustees to look at and review at some point in time. There's been a lot of changes to your investment program over the last 5 or 6 years. These are things that your investment committee, your board, your internal team, and your consultants have been working very hard on. We've increased your exposure to alternative investments. We've increased exposure to private equity from 5 to 10%. That's added terrific value in your investment program. We've added a newer asset class called infrastructure. This is things like ports and airports and bridges and tollways and other such things. And we've made some eliminations in the real estate program as it relates to publicly traded REITs. We've done that to try to drive returns, take advantage of your current liquidity profile, and to lower costs. So in public equities at the top, we've reduced some of the biases. You were very heavily weighted originally to U.S. stocks. There are some small cap biases there. We'll show you in a few pages. We've made some changes there. In fixed income, probably the biggest change we've made in fixed income is we made your bonds very conservative. You have 1 to 10-year maturity bonds in your portfolio now. Almost all U.S. investment grade, high quality bonds. So why did we do that? Well, that's the best insurance policy we could think of when things get bad. In like a 2001 and 2 environment, when the dot-com bubble burst, or a 2008 environment, you want that core anchor of very conservative, highly liquid fixed income. And that's been in place and operating the way we'd expect. This colorful exhibit shows asset allocation over time, a little zigzaggy. It looks like something you might see at a hospital emergency room. A couple things to note. If you look at the bottom three colors, the blue, green, and yellow, these are our marketable equities. So publicly traded U.S., non-U.S., and global equities. That's slowly been coming down. We've decreased our exposure to these asset classes. As we've done that, we've been increasing exposure in illiquid private equities. That's shown at the top of the chart in blue. Very intentional, very deliberate, trying to add value, take advantage of your liquidity profile. There's some things that we've turned off, like non-U.S. fixed income, and other things that we've turned on more recently, like the Opportunity Fund that is shown here. Let's bring it all together and look at what our expected return is when we take your asset class targets and apply our capital market assumptions. So I would focus attention on the column that says current under total fund expectations, 6.64. So less than when I was in front of you a year ago. When I was in front of you a year ago, the number that we illustrated was 6.78. Why is it less? Well, I've used this expression a lot with your committee and your board. We've basically been reaching into the future and pocketing rates of return that should have been earned tomorrow, and we've earned them today. Not a bad thing, but we just expect that the future will be more difficult because we've earned what we think are, quote, outsized returns more recently. So your actuarial assumed rate of return is 7%. We think your long-term rate of return is 6.64%. There's a little bit of a disconnect there. We're not encouraging you to change your discount rate. We're just wanting you to recognize that there is a gap between what your actuary is using and what we have here. Let me pause for a second.
You're not discouraging us from lowering our discount rate either. You're neutral. You're Switzerland. I don't know.
Yeah, the investment consultant's role isn't necessarily to tell you what and to dictate what the actuary does. We work in concert with your actuary. We share our cap market assumptions. He sees those and those of other firms and makes good, prudent decisions, or advises you to make good, prudent decisions. Your 7% discount rate now is, I think, the right discount rate for where we are. You've been lowering it. You've been doing the right things. There is a national, quote, best practice of lowering discount rates. 8% used to be the average when we looked across not only the state of California, but across the country. That's far too high in our humble opinion. And so the changes that you've made, reflecting back on that formula, benefit payments, equal contributions plus investments, that you're squeezing the balloon when investments can't generate that 7 or 8% return. And we recognize that puts a burden on the sponsor for higher contributions.
I just wanted to jump in here real quick. One of the reasons that we asked Steve to stay over is because this material is just so foundational to our discussion that we're going to have later this year about our actuarial assumptions. So ordinarily, we have Chiron come to the board, excuse me, in September to talk about economic assumptions, specifically the discount rate and the wage inflation rate. And given the amount of interest that we've had on this and discussion we had at our board retreat, we're actually going to have Chiron come back in July and in September to continue this whole discussion about the actuarial stuff. So what Steve's covering today is just, again, very foundational for us to have that base info before we debate on discount rates. Thank you.
If I can, I just have, my question on that is, if you're forecasting a performance that's below what we're saying we need to run the plan appropriately, why wouldn't you be encouraging us to reduce the discount rate?
Yeah,
Are you going to give us some great returns next year that's going to surprise us? Are you going to lower your fees so that we make up the difference that way? What's the plan?
There also has to be all sorts of solutions on the table. The one thing we spent a lot of time talking about yesterday at the investment committee is that that expected return of 6.64, I can tell you with certainty, will be precisely wrong in 10 years, in 20 years, in 30 years. It's not going to be that. These are our best estimates based upon what we think are good foundational work, not different from what others in the industry are predicting, but it won't be exactly that.
But it's the middle of the bell curve of statistics.
Correct. Yeah, it's kind of the center point of around a distribution of expected returns. And so we don't want to drive your actuarial discount rate solely based upon that alone, because we recognize there's going to be noise and there's going to be variability in that, and the consequences of making those changes can be significant. And these are things that I know Mark has to take into consideration, the board in a total has to take into consideration, working with the sponsor and your actuary and coming up with a good, sound, ultimate policy at the end of the day. Very good question. We spent a lot of time on that yesterday about that is that a precise number? And it's not. It's meant to be directionally accurate, but we know that it will be precisely wrong. It's a little bit of a humbling job that we have here when we're trying to do this.
So the important aspect is the number's good enough for us to hire you, but not good enough to rely on.
Well,
I'm just giving you a bad time. You're fine.
okay, then I'll move on. I won't try to address that. One of the important things to do is we don't want herd mentality. We don't want to look over our shoulders and do what everyone else is doing, but it's good to look over your shoulders and just see where other people are. And so we grabbed some survey data from an organization called Greenwich Associates. This is for pension funds, similar size as you, $5 billion and above. And we just like to know what others are doing in terms of asset allocation and other such things. They're basically trying to achieve the same objectives you are, defeasing a long-term liability with similar discount rates. So we'd expect your asset allocations to be roughly in line with those of your larger peers. By and large, you are. You have a little bit less in public equities, a little bit more in illiquids and more diversifying investments like real estate, like private equity. And then the way folks respond to these surveys isn't all consistent, and so we have something called an opportunity fund. Many of our other clients, many other institutional investors do. They just may call it different things, and so your opportunity fund may appear to kind of stick out here at 8%, but by and large, you're very similarly structured relative to large peers.
Steve, I just want to ask one more question on this. So the peer number of 6.64 is using their asset allocation and Aon Hewitt's capital market assumptions.
That's right.
So these peers, if they're using different capital market assumptions, might very well say their expected asset allocation is going to be generating a number that's higher or lower than that.
That's right.
Right?
That's right.
Okay.
Yeah. One of the for the sake of focus and brevity, I took out a slide that we spent some time on yesterday, which showed a survey data set from a group called the Horizon Study, that shows expected returns for all your asset classes and others from 35 different institutions around the country, investment consulting firms, actuarial firms. The big takeaway there that I think is important is that the assumptions that we share with you, that we use with you, we're basically right in the middle of this distribution of peers. We're a little bit more conservative, though, and I've said that to you in the past. I said that to your investment committee in the past. We're just slightly more conservative. We're not as confident that expected returns in the future will be as good as they have been in the past.
More than a 0.36 conservative, or
0.36.
which gets
To
us
get to
back to 7?
Yeah, that's good. Yep. Not quite, but close, but very, very close. So this is all looking ahead, which is important to do, but we know the crystal ball can be cloudy. What we know for certain is what we've actually generated. So let's take a look back. Your returns have been truly exceptional. We use the word decent here. That's not a good enough word. We should say exceptional. The trailing 5 and 10-year returns have been great, 8.7 and 8.5% net of costs, net of all fees. That's a pretty good return. That comes on the heels of a difficult market environment, obviously, in 2008, so your returns have really ramped up. We don't expect that on a go-forward basis. What we've shown here in the exhibit is rolling 5-year returns, so what have those been, and rolling 10-year returns, along with the averages. Look at the rolling 10-year. That is the green line, the green line. So there's been periods of time where you've been below and periods of time where you've been above your current assumed actuarial rate of return. The importance of looking at that is we know there's going to be bad times as well. We know that we're going to be looking back in the rearview mirror at performance in one of your board meetings, one of your investment committee meetings, and your return for the previous 10 years will be below that 7%. That doesn't mean we change strategies. That doesn't mean we change asset allocation. In fact, it likely should mean that we rebalance. We buy what's been doing poorly, we sell what's been doing well, and we adhere to our long-term policy decisions. Not easy decisions to do sometimes. You did that in 2009. You adhered to your long-term strategy, and that helped you come out of that market environment very strong.
May I ask a question? Steve, thank you very much. Can we go back 2 slides? I'm sorry, I didn't really know how to use this system here to interrupt.
Is this the one?
No, one more back.
Here.
Yeah.
Okay.
So, as you said, you have prepared these projections very conservatively. So can you identify here by line item which that you feel are the most conservative and what the range would be? Thank you.
Sure. And I'll do this without the precise data in front of me. We're fairly conservative on real estate. So real estate's 11% of your investment program. We have an expected return for real estate of somewhere in the neighborhood of 5.2. I think that's low. That is compared to peers and compared to historical actual experiences. I think historical actual experiences for core real estate, Carol help me, has probably been 7.5%. At some point in time, we do think we would get back to that equilibrium rate of return. So that assumption is rather low. Our return assumptions for equities is about 6.8, 6.5. That's about spot on with where everyone else is right now. Historical actual experiences for equities over the last 20 years is probably about 7.5, close to 8%. Most practitioners do believe that those will be diminished. Those are probably the biggest differences. Our 10%, pardon me, your private equity allocation at 10%, we have an expected return there of about 9.5. That's very close to what most forward-looking people or practitioners are seeing private equity at. Good questions. Thank you.
Can I make a follow-on point to that? Because that was a really great question. Your capital markets assumptions are for really core, well, they're for beta. They don't really reflect alpha of us beating the market by having better managers or doing unique strategies, say, in the private assets. And so, for example, the real estate at 5.2 is core, kind of plain vanilla operating real estate, but we have a 20-something% allocation to non-core real estate in our real estate plan, which is shooting a little bit for the fences. So ditto, I think, with infrastructure. Yep. So the assumptions that underline this 6.64 do not take into account the potential that we are beating the market in certain asset classes with our managers and our strategies.
Yeah, well said. That's an important comment. This goes back to if we do have any bias in what we do, it is that of conservatism. Right. We want to be a little bit more conservative than aggressive. We don't think there's anything gained by being overly aggressive. But there are elements of your investment program that would call for rationally an expected return higher than 6.64. We just don't want to model that because that's the slipperiest stuff out there, right? The value added from investment managers is kind of the hardest thing for your investment team, for your consultant to grab onto. And that's one of the reasons why we don't model that.
And if you listen to Vanguard, it doesn't exist.
Yeah, well, and I'll show you some data that illustrates that as well. You index a lot of your capital, and we think that's a terrific idea. And you spend those fee dollar savings and the risk budget savings, and you spend it in things like private equity, private real estate, and infrastructure, and the Opportunity Fund. That's exactly what we think you should be doing. That's been a major effort on the part of your investment team and us with working with the investment committee over the last 5 years. Spend the capital there, get the beta cheaply as you possibly can, and then diversify in the alternative investments to try to enhance returns, keeping in mind your liquidity profile. Partially closed plan, so at some point in time, we're going to need to revisit that structure and think seriously about how we manage the pension on a go-forward basis. Good discussion, good questions. I want to be mindful of time. I promised Mark that I'd be done in roughly 20 minutes, and I've used 22 minutes so far. So I'll keep going until you all give me the axe otherwise. So let's move back ahead.
Go ahead and finish as you had intended.
All right, thank you. Let's take a look at one important element of your investment program that's new in the last 5 years, well, 7 years now, is the Opportunity Fund. And we spent a lot of our time with your investment committee on this and with your investment team on the Opportunity Fund. The Opportunity Fund was created in 2010 to ensure that this investment program had access to things that don't neatly fit into the asset allocation that I just showed you, to have the ability to emphasize opportunities in the capital markets that may appear compelling, whether that be distressed credit or high-yield bonds or emerging markets or real estate, things that are already in your program that we really want to emphasize and we want to overweight. We don't want policy to be so constraining. Recall that I used the expression flexibility earlier. The Opportunity Fund gives us flexibility at the investment committee level and with your investment team to emphasize things that we think are going to add value to the returns of your portfolio or diversify risks. That said, there's not always opportunities in the marketplace. And sometimes the best call of action is to do absolutely nothing, to look at the landscape, review investments, review more investments, and decline on a lot of things. We decline on more things than we actually do. And there's a lot of things that end up on the floor before we come to the investment committee for a recommendation. We think that's fine. There might be quarters in a row where there's no new investment going into the opportunity fund. So we don't want to force something. We're not seeking to hit that maximum unless there's something compelling. So where we are right now, we're at about 3.5%, trending up to 4% in terms of committed capital. 2 investments were made yesterday by the committee for $100 million in aggregate. That will be discussed here in a little bit by your investment team with the full board. Let's see how we've done in the Opportunity Fund. It's actually done rather well. When we look back, since we have reliable data, and since the program truly took its structure, which is 2014, not that long ago, 7% return compared to the opportunity cost benchmark. What's that? Well, that is a mix of 78% your return-seeking assets and 22% fixed income. 78 stocks, 22 bonds. You could go to Vanguard and buy that for 3 basis points probably. So we wanted to see how have we done over that hurdle. We've done remarkably well. So the thoughtfulness of the investments that your investment team have brought to you and the timing of some of these things have worked out well. We have a 7% return. It may not always be that good, and there have been times when we've looked backwards where returns have been a little bit more subdued here. There's 2 current structure strategies in the Opportunity Fund. One is real estate based, and we've been looking at real estate debt as a way to protect some of your investments and to enhance returns. We're looking at returns of, say, around 10 to as high as 15%. And the other has been opportunistic credit. We spent a lot of time yesterday and in previous meetings looking at the global markets, and what we think is one of the better opportunities right now is credit-based investments. And you have several investments that fit into that category. So overall view of asset allocation, it's appropriate. We don't think you should make changes to the structure of your asset allocation at this point in time. You continue to be very broadly diversified. You get that diversification cheaply. You do have a lot of alternative investments, appropriately so. It's up to 32% when we take into consideration your 8% in the Opportunity Fund. So things like private equity, real estate, and infrastructure have been additive. You have that element of flexibility that I mentioned, downside protection with a very conservative fixed income portfolio. And even though, again, I want to stress this, even though you're a partially closed plan, you have a lot of liquidity in your investment program today. 70% of your assets could be sold on the open market without a discount in a day. Very liquid stock bond portfolio. That other 30% would take some time to work out, but those are there to try to drive returns over time. Let's look forward a couple of slides, and we'll talk a little bit about liquidity. And we spent a decent amount of time on this yesterday because it's a really important issue. Right now, we know your benefit payments exceed your contributions. You have a negative cash flow situation. That's not all that unusual. You're among good company. That may not be comforting, but most of your public fund peers across the country also are in a negative cash flow situation. Right now, you're at about 3% negative cash flow. And I'll illustrate that. We do some simulation analysis to look at how that cash flow could change in bad environments or good environments on a go-forward basis. 3% is an okay place to be. When we start to ramp up closer to 10%, we have a problem. And that's when we'd likely need to change your investment program. We wouldn't be able to take advantage of private equity and private real estate if and when liquidity outflows are around 10% or so. Let's take a look at the chart that we spent a good amount of time on yesterday. So this is something, those of you that were part of the asset liability study last year would recall this. What we're doing is showing your net outflows over different periods of time going out to 2044. And we're simulating different return environments and how and different contribution environments and how your net outflow changes over time. I mentioned you're around 3% net outflows right now. That's shown on the left-hand side at the far right. If you follow that dotted black line, this is our base case, the central scenario of how liquidity changes over time based upon your contribution profile, based upon your benefit profile, and then based upon different economic outcomes. So liquidity outflows start to increase over time. Why is that? Well, it's because your funded status improves. The city's making its contributions, your funded status improves. There's a point in time where your city contributions drops off quite significantly, and I think it's 2028, 2029, right around there, that you could see that change, that little spike up in the black dotted line. That's when those contributions stop. You don't pierce 6%, though, under the simulations that we show in our base case scenario. Only under the green, the darker green, light green and dark green, do you start to get into problem zones. So no call of action right now, but every year we look at this. Every year we stress test. We look at your contributions. We look at the change in your funded status. We look at the investment program. We do simulations like this. We sit down with your investment committee and we revisit. Nothing needs to happen, in our opinion, right now. In fact, you actually need that illiquidity to try to get closer to that 7% return. Let's flip forward a few pages for a couple different things. I mentioned your highly liquid investment program. What we've done here is we've taken all of your asset classes, your stocks, your bonds, your private equity, your real estate, and we bucket them into different liquidity buckets. The 68% highly liquid. Again, these are things that could be sold in a day with very little economic impact to the fund or to those investments. When we look at quasi-liquid, these are things like the credit investments in the Opportunity Fund and real estate. You could generally get those things out in a quarter, maybe in a year, but in a bad time, candidly, in a 2008 environment, those will lock up. You would not be able to get those assets out. And then when we look out further, we have your real estate investments and your private equity investments that are fairly illiquid. Your private equity investment's shown at 13% and liquidity of 10 years or greater. Likely, you have better liquidity than I'm illustrating here because you invested a lot in secondary markets. You ameliorated the J-curve effect, invested in some secondaries, and so you likely have better liquidity. But for sake of conservatism, we wanted to use this number. So we then take this. We stress test, we look at your contributions and your benefit payments, and we look at different economic scenarios. And what we want to know is what happens if something really, really bad happens? What happens if we have a 2008 type of environment? What happens to your liquidity? Are you going to need to sell illiquid assets to make benefit payments? That would be a bad thing if that were to happen. And, whoops, my computer has frozen up.
No, Val just turned it off.
Is that the hook?
Yeah, help.
Sorry about that. Okay.
Steve, while he's doing that, could I ask a question?
Please.
If we are now, 11 years out from that magical year of 2028, when we get to be 10 years or 9 years or 8 years, if we have an illiquid portfolio of 13% allocation to illiquid assets, does that mean that even though nothing's gone poorly, everything's gone well, we still need to make adjustments in order to be prepared for that event in 2028?
So
or
we
not?
want to see what your funded status is. If you continue towards full funding, we would start to de-risk your portfolio. We would put liquidity back into the program. You wouldn't need as much private equity. You wouldn't need as much risk.
So if we did really well, we wouldn't need to take as much risk to generate
Correct.
higher alpha and
You wouldn't need
better
the 7%
returns.
return. You might need a 5.5% return. You might need a 6% return. That's why we look at this on an annual basis. And we set policy for the long term, but we need to revisit things in shorter increments to make sure that we're mindful of the current market environment around. So close your eyes and picture, if you will, a sunset.
Well, Steve, can I ask you a question while we're waiting for the computer to come back? So I just want to clarify or put it all together. So recently you just said we have a negative cash flow. Our discount rate is 7%. We have a unfunded liability of, I forget what that is, but you still maintain that SDCERS pension fund will reach 100% funded status at the scheduled time, 30 years, I believe. So I just want to clarify that because
The answer is
future
yes.
discussion.
So all those observations. So a lot of assumptions go into that. We have to hit 7%. The city has to keep making its contributions. Your demographic profile of your members has to remain consistent. And we know all those things are going to change. And that's why your actuary does experience studies. That's why your investment consultant does asset liability studies. And we revisit those things periodically. But that's right. That is kind of the macro data that that we have. Thank you.
Just for further clarification, so we are in a position where we're required to take some risk in order to meet those assumptions or those expectations, where if we were better funded, we could de-risk the portfolio and would be able to accomplish the same goals with less risk.
Yes.
Okay.
Yes, absolutely. So this is a sunset picture I was asking you to imagine with your eyes closed. So this shows a central economic scenario. You earn the 6.64%. There's no rocky roads. Your contributions and benefit payments are as modeled by the actuary, and everything is just fine. So what that tells us is that we don't have to do anything drastic under the central scenario when we look out over the next 10 years. So what happens in bad scenarios? So we took what we call black skies economic environments, and this is like the far left of a return distribution, say the bottom 5% of expected future return outcomes when really bad things happen. And the picture changes a little bit. So your blue line, that's the liquid stuff I mentioned earlier, that roughly 70% of your investment program is currently in liquid. That gets stressed, that gets pushed. And your quasi-liquid, things like real estate and your private equity, start to get larger because the pot is shrinking, right? The pot is shrinking. Their proportionate size of the illiquid gets bigger. But still, under this type of environment, over a 10-year period of time, based upon current benefit payments and contributions and these simulated analyses, there's really no need to sell things like private equity to make benefit payments. You're still doing okay. What happens if that same environment happens after the actuarial determined contributions stop or decline, or they dramatically shrink in about 2028, 2029? That's not so bad yet either, in part because as this bad activity happens and contributions were coming down, you were fully funded getting into that environment, and so we would likely be able to de-risk your portfolio. And what we want to stress here is that, again, there's no, quote, fire sell. We don't need to sell a liquid private equity or a liquid real estate to make benefit payments. We may have some problems rebalancing the portfolio. These wouldn't be fun meetings. We would be looking at a risk profile that's pretty terrible. But the fund will go on, and we'd be able to make benefit payments, and we'd be able to come out on the backside of these difficult environments looking ahead. Let me pause for a second, and we're going to go to structure, and I'll try to wrap up probably in the next 5 minutes or so. Any questions about liquidity or asset allocation or expected returns? Okay. Many of you have seen this before, our core beliefs, and these are shared beliefs. These aren't Aon Hewitt's beliefs as much as they are our beliefs with you and the investment committee. There's certain tenets that we think are important that we always need to look through these lenses when we're making decisions. And one is get breadth, get diversification. Recall the importance of diversification that I mentioned earlier. There should be no unintended biases in your investment program when we're looking at structure. Pay little for market returns. Again, you can go get it at Vanguard or State Street or BlackRock for a few basis points. We don't need active management to get beta. We should do that very cheaply with passive management. And then keep it simple and keep costs low. And use your fee dollars in higher value added areas like private equity, real estate, and other diversifying assets. So those 6 considerations: diversification, downside protection, seeking alpha sources, liquidity, flexibility, and cost, all of those things have been factored into when we look at your structure of your investment program, how we get your equities, how we get your fixed income. So over the last several years, we've dramatically increased your passive investments, those assets that are indexed. Why? Well, because active management is a very difficult game. Most active managers underperform, and I'll show you that in just a few minutes. We've also taken a lot of cost out of your investment program from the stock bond portfolio and taken those fees and put them into alternative investments, higher value added. That's been the major theme over the last 5 or 6 years with the investment program. We're going to skip ahead to slide 36 and talk about a little bit of a technical aspect of something called tracking error or active risk. So the expected return of 6.64% that I mentioned earlier is what you might expect if you were to index everything. That's what you could get from the marketplace. And Carol mentioned that we do use active managers in some areas, so what about value on top of that? Active risk or tracking error attempts to measure how we might be different from what the capital markets are giving us. What are the managers doing to try to generate value added? And the way to think about this is that if you have an expected return of 6.64, based upon that 0.44%, you would expect two-thirds of the time that your returns would be 6.64 minus 0.44 or plus 0.44%. That's a pretty tight level of active risk. It's intentionally built that way. It's declined a lot over the past few years for two reasons. One, the markets have been calm, right? We've had decent capital markets over the last 5-6 years, kind of in one steady direction. The other reason is that we've increased indexation quite a bit. So we've taken some of the opportunities out for alpha or for active management, and that's caused that number to shrink. Your investment team and your consultants are always looking for things to do to try to change that. We made a strategic investment in an equity manager about 4 or 5 months ago to try to take a little bit more active risk where we think it might be beneficial. I did want to talk a little bit about active and passive management because it's just a timely topic, and people often ask, why do we have so much passive in this investment program? We're a big, sophisticated investor. Can't we go out and find the best active managers that generate superior returns and we could all go home and be happy? It's not that easy. And what we show here is some very good survey data using the source called S&P SPIVA data, looking at U.S., non-U.S. equities and emerging markets. And this shows the percent of actively managed funds. These are, and Karina asked this question yesterday, these are institutional funds and some retail funds. So it has institutional fees and retail fees as well. It's a blend of the two. And it's the percent that have outperformed the benchmark over time. These are low numbers. Active management is a very, very difficult game. This is why we have so much in passive. Let's look at it a different way. What we did here is look at rolling 12-quarter returns. And so when we have a dot that is below that black line, that means the median active U.S. equity manager has outperformed the indexes. And when we have a dot above the black line, the median manager has underperformed. It's been a really tough environment for active managers as of late. It's not impossible, but alpha, or value added, is cyclical like many other things, and it's really hard to predict when those inflection points will come. And that's why we maintain, as shown on this page, the level of indexation that we do. 53% of your U.S. equities, similar to what your peers do. We have a little bit more in indexation in non-U.S. than your peers. And again, we're always looking for good active opportunities. Candidly, we just haven't seen many lately. And then fixed income, we have quite a bit more. And that's in part a deliberate structural decision. We want you to have very conservative, simple bonds in your portfolio for that insurance policy. I just have a couple more things to show you. We talked about biases earlier in your investment program. We don't want any unintended biases. U.S. equities is one of your biggest asset classes. It's 24% of the total fund, or $1.7 billion. Very broadly diversified. You have 5 different managers. 53% of your assets are indexed to broad market indices. But there's a little bit of a bias in your program, which has been in place for many, many years and actually done quite well for you. And you overweight small caps very slightly. And let me just show you that graphically on this page. So we've bucketed stocks into different categories: large value, large growth, mid cap, and small cap. Look over at the far right, you just have a little bit more in small cap. The investment theory there is that smaller cap stocks will generate superior returns over mid cap and larger cap stocks over market cycles. And that's been true for you. It is a little bit more volatile, but we accept that volatility because we're long-term investors. I'm going to skip way ahead and bring it in for a landing here. And I think this will key up a future discussion that you're going to have in a few minutes. The Opportunity Fund, let me get current on my slides in front of me. Opportunity Fund, again, is something we spent a lot of time on. Yesterday, we heard from 2 investment managers, Davidson Kempner, that you have an existing investment with, and a firm called Oaktree. Davidson Kempner is a distressed credit manager. An allocation decision was made for $50 million, and then Oaktree is a large organization based in Los Angeles, value investors that will be investing in real estate debt for $50 million. So the manager allocation commitments shown on the left-hand side, $260 million, that will be $360 million. We continue to look at investment opportunities in that space with your investment team, and we'll be bringing more ideas to your investment committee looking ahead. So this is the conclusion page, just a couple things that we're looking at managers that have more flexible mandates. We had our head of our hedge fund research and our liquid alternative research, Chris Volvord, here yesterday meeting with your investment committee. You will likely see him or hear from him again in some of his work as he's looking at multi-strat and inflation-protected strategies. These are the types of things we want to talk more about with your investment committee. To sum up, we think your investment program is in reasonably good shape, actually very good shape. It's a low-cost structure. You take opportunities to use your liquidity wisely by investing in private equity and real estate. That continues to be something that we're going to pay very close attention to as your circumstances change. Right now, you could bear that liquidity. We'll continue to bring new ideas to your investment committee as we go forward. But I'll conclude there and say thank you for your time and see if you have any questions or comments.
Any questions?
No one in the queue.
No one in the queue.
Thank you all. I appreciate it.
Thank you, Steve. We appreciate your time staying over and kind of your steady hand on the program here and all in all, reasonably steady news and look forward to working with you in the future.
Thank you. Thank you all.
Thank you.
Okay, so we now have two motions out of this, right? So the first one is a motion to approve Ann Hewitt's asset allocation recommendation. I need a mover.
Chair.
Oh, I'm
here,
supposed
you
to move
can-
it?
You can move it and no second is required.
Okay, there, I need a button, there we go. Okay. Great, so now we can vote.
Ready to vote? All votes are in.
And that is approved 12-0. I probably also should have said that it was approved yesterday 4-0 by the committee. So the next motion is to approve the structure. Number 2,
Are we doing a manager structure?
manager structure. So this is to approve the recommendation on proposed manager structure, which was the second part of the presentation about active, passive, biases, et cetera. So I will move for that.
The committee passed that yesterday.
Committee passed that 4-0, thank you.
Ready to vote? All votes are in.
And that passes 12-0. Okay. So now we're going to move on to two investments Steve mentioned that were approved yesterday, and we'll be looking for your approval. They're both for the Opportunity Fund. Demetrios and Anders are going to present the first one, which is the Davidson Kempner Special Opportunities Fund 4, $50 million commitment to a distressed credit opportunity.
Thank you, and good morning. Steve gave us a little preview, but I'm just going to go into a little more detail. And just a reminder, this is also another action item. So $50 million commitment to the Davidson Kempner Special Opportunities Fund 4. This is an overflow fund, and it focuses on distressed credit investments, not only in the U.S., but abroad. Characteristically, it's very similar to the Special Opportunities Fund 3, in which SDCERS is already invested. It's a concentrated vehicle of about 10 investments, focusing on private senior secured debt that offers attractive returns and diversification for the Opportunity Fund and also for the total portfolio. And the net IRR is expected to be between 10 and 14%. And then if there are any questions, we are happy to answer.
Questions?
I have a question. Is it collateralized by real estate?
Andrews?
Some of it will be in the sense that in the Fund 3, there were a couple of mortgage-backed securities loans that had real estate as collateral. Fund 4, we're not really sure exactly what they're going to put in there yet, since that gets determined when the fund starts the investment period.
If I could just briefly comment, you said it was an overflow fund. Can you explain what that means and also how the fee structure works?
Sure. So Davidson Kempner has a variety of other funds, and if they have a deal size that is too big for one of their other funds, it will overflow into the special opportunities funds that they have. And then the fee structure, once you reach a commitment of $50 million or above, you have a choice of a 50 basis point management fee and 15% performance fee after an 8% return, or a 75 basis point management fee and then a 10% performance fee after that 8% return is reached.
So the fee is on committed, not on committed capital, it's on invested capital. So
Yes.
because the deals are coming in as overflows from other products and they're not really just spending time trying to fill up this fund, you don't have to pay those onerous upfront fees. So on balance, it's an attractive fee structure.
Yep.
Okay, any other questions?
And just a clarification, there's going to be no overlap between the existing fund investments and this new fund.
Exactly.
Okay. With that, no questions, then we're going to proceed with the motion, which is to approve staff and consultants' recommendation for a $50 million commitment to the Davidson Kempner Special Opportunities Fund 4 for the Opportunity Fund. I'm making that motion. Also, this was approved yesterday 4-0 by the investment committee.
Ready to vote? All votes are in.
And this motion is passed 12-0.
Thank you.
Thank you. And next, Jamie is going to introduce or present to you the other investment we approved yesterday. It's a recommendation to invest in the Oak Tree Real Estate Debt Fund 2, which is also for the Opportunity Fund, and ended up being a $50 million commitment.
Yes.
You can tell that story if you want.
So as Carol alluded to, the committee recommended an allocation or a $50 million commitment to the fund rather than a $40 million commitment, basically to keep it even with the previous item that you just approved. Although it's different from our pacing, it is something that staff does support. If there's any, are there any questions that I could answer about that? Otherwise, I can give you a brief summary of the fund. Okay.
When you say different from our pacing, just so everybody
Our,
understands.
excuse me, thank you. Our pacing model says that we were going to make $40 million bite-size investments for the Opportunity Fund. In this case, $50 million is not that different. It won't have a significant impact on that pacing or allocation. Okay. So the Oak Tree Real Estate Debt Fund 2 is a closed-end value-add fund that will focus on investments with current income and attractive risk-adjusted returns. Oak Tree will seek to build a diversified portfolio of investments across 6 different areas within the private and public debt space. This strategy will allow them flexibility in selecting the best opportunities in the market for the fund, and the fund will primarily invest within the U.S. However, they do have the ability to invest within the UK, Germany, Japan, and South Korea. They are expecting an IRR of a 10% net basis. And with that, I'd be happy to answer any questions that you have about this fund.
I'd just like to comment that I was the instigator to up it from 40 to 50 million. First of all, I'm familiar with them. They're a pretty good outfit, and this is a fairly low-risk fund. It's going into the Opportunity Fund, which is well below its 8% allocation or availability. And so after quizzing a couple of people, they seemed to have no objection to, they were fine going from 40 to 50, and it just seemed the right thing to do. So I made the motion. That's the rationale.
And the vote was 3-1 at the committee.
Vote was 3-1. And if I could just, you want to just make that comment, Jeffrey? Jeffrey was the one.
I voted no on the motion. In their presentation, well, when they're an active manager, and I believe we just heard from Steve, we're going from more passive than active managers because of the return. When he was speaking, I forget his name, from
John.
Oaktree, John from Oaktree, he was not interested in going outside the U.S. market for their investments. And I asked him why. He said just they're more secure in U.S. than any other, or non-U.S. Jamie just said they can go to UK or Germany or wherever other countries he said.
Japan, South
But
Korea.
that wasn't consistent with what he said. I believe you. He didn't say it at the time.
It's more so they have the ability within the fund documents is what I was referring to. He is seeing the best opportunity within the U.S. and not so much in Europe these days. He did mention maybe South Korea, but the opportunity truly lies within the U.S. There's the greatest transparency and risk-adjusted returns here within the U.S.
And I believe some of our other real estate money managers also said that non-U.S. was trailing U.S., so it seems to be opportunity there. But I'm not arguing with you. I'm just think these are things that were rattling on in my head. And then finally, at the last minute, we changed it from 40 to 50. I just thought that if investment staff wanted 50 million, they would have asked for 50 million, and they have their models and their calculations, and so the combination of all of that is why I voted no on the motion. I'm not sure what I'm going to do right now.
Okay, thanks, Jeffrey. Okay, if there are no further comments, we'll proceed with a motion to approve staff and consultants' recommendation for a $50 million commitment to the Oaktree Real Estate Debt Fund 2 LP for the Opportunity Fund. George moved that. Is that okay?
That's fine.
Okay. So ready to vote?
Ready to vote? All votes are in.
And that motion has passed 12-0. Thanks, Jamie.
You're going to be seeing more of me. I'm going to
Yeah, you can just stay there. Okay, so moving on, the next item is number 5. Johnny Tran and outside investment counsel Peter Mixon presented the new insider and personal trading policy, which sets SDCERS' position on insider trading, creates systems to control the dissemination of material non-public information, a self-reporting, and training requirements. The Investment Committee voted 4-0 to adopt the new policy. The policy was adopted as part of B&G's consent agenda, which we actually haven't had yet. It will be. Therefore, no vote is needed now. Is that fine?
Correct.
Okay. Thank you. Okay, so now we're moving into the no action items, and Jamie's going to run through several items.
Yes, I promise to be brief on each of them. So yesterday, the Investment Committee heard we're on the Stepstone item. There we go. Yesterday, the Investment Committee heard a presentation on infrastructure by Stepstone, one of SDCERS' discretionary private market advisors. Over the past year, the infrastructure portfolio has experienced some volatility due to its exposure to the energy sector, particularly within oil and gas. I'm happy to report that as of Q4, the portfolio has rebounded to a net IRR of 4%. At its low point, it had been negative 1%. Stepstone expects this appreciation to continue due to the continued recovery within the oil and gas assets, as well as the outperformance of secondaries. The portfolio currently consists of 16 investments with commitments of $128 million. The two highest exposures are to oil and gas and power generation sectors at about 40% each. The next steps for the portfolio are to continue to diversify the portfolio. Stepstone would like to increase the current income and also to dampen the volatility of the portfolio just so things are more smoothly. We're not seeing the ups and downs so much. We're planning to do that by pursuing investments within the renewables sector, as well as potentially telecom with the birth of 5G wireless, perhaps water or natural resources. And with that, I could answer any questions that you have. Great. Thank you.
Go ahead.
All right. Next slide. So the next item is the individually managed transition update. That is a long way of saying the individually managed account is what IMA stands for some of the newer trustees. Yesterday, the investment committee heard a presentation from Aon Hewitt, our real estate consultant, about this transition, and the account is managed by Deutsche Asset Management. You recall that we are employing a two-pronged approach to wind down this account. There are 19 assets within the portfolio. The first prong, we are taking 3 industrial properties that we are exchanging for shares of a buy-rated core open-ended fund. In this case, it's AEW Core Property Trust Fund. We're making great progress. The legal negotiations are continuing, and we expect the transaction to close in early to mid-July. So things are moving along just as they should there. For the second prong, we are selling properties into the open market, and we are also making good progress there. We have 1 property that's been in the market. We are finalizing negotiations on pricing for that asset. 4 more properties have gone on the market within the past 2 weeks. So we are doing exactly what we thought we would be doing here. For the rest of the year, we will be evaluating 2 more assets for sale. And then longer term, we have 6 that will be sold within the next 3 to 5 years. Our next steps are to consider where we will be investing the dollars from the direct sales, the longer-term sales, that is. So we'll be doing some planning to envision what we want the portfolio to look like longer term. In July, we expect to bring forward a manager for your consideration, as well as looking at our annual investment plan, which is our roadmap for how we are planning our work and pacing over the upcoming year.
Jamie, so I understand the object here is to get out of direct investment in specific real estate assets, and I assume that's a risk avoidance strategy. Are we going to get any kind of report on the performance of specific assets or on this class of assets when we're out so that we understand? I mean, I understand sales are going well in the sense that we have activity, people want to buy these assets, but how are we doing in terms of return on these?
Meaning the existing portfolio?
Yes.
So those assets, they're not bad assets. They're not bad assets at all. They're smaller assets, and that's the risk that we were concerned about. They're in the manager structure, you heard about small cap focus. That's what these are. They're small cap, they're more volatile, they're more subject to the ups and downs, which we don't want for the real estate portfolio. We want that steady anchor, providing that current income. These are core assets. So we just want the income component. We don't want that appreciation bouncing around so much.
But we're not doing a fire sale either.
No, absolutely not. The assets that we are selling are ready for sale. They don't have any tenant issues. They don't have any debt outstanding that's going to cause any prepayment penalties or anything along those lines. It's a good time in the market to be selling. So we're looking at them. If we get good pricing, then we'll move forward.
All right. So when you report that things are going well, it's not just that we're moving them, but we're moving them at fair pricing that gives us a decent return.
Which is why the one asset that I referred to that's in final price negotiations, that's been in final price negotiations for a few weeks now. The buyers, Deutsche Asset Management wasn't exactly happy with the price that people were coming back with, so they're trying to bump things up a bit.
How much involvement does our staff have versus the manager, Deutsche Asset Management, or the lawyer?
The manager has full discretion. We are fully engaged with them to get as much information as we can, as well as their real estate consultant.
But we don't make the calls, they're doing it.
No, I mean, they do run things by us to say, hey, we're looking to put these on the market.
Right.
This is consistent with what you want, right? And that's what we...
And just to give you a little bit of extra color, the prices that we're selling these assets at have all been above their most recent carrying value.
And as we're generating these proceeds, that cash is being equitized, as I understand. And what is our relative weighting to real estate right now versus our policy?
We are slightly underweight real estate. I believe we're at about 8.3% of our allocation. Maybe 9?
9.3.
No, I'm sorry, 9.3. And The dollars continue to be invested. Any cash that is outstanding is being overlaid to our strategic asset allocation through the cash overlay program. But we are planning, we do have one investment in the queue for the investment that was approved at the last meeting for Morgan Stanley. That $15 million is still in the queue. We also have another outstanding commitment that we will be in the queue for PRESA, the Prudential Real Estate Fund. That will be in the queue at the end of this quarter. That's the next time they open.
Yeah, so getting this capital redeployed into core open-end funds is a real priority, and we're going to be looking at a plan in July with Aon Hewitt's real estate team to ascertain what are the best funds, taking into account both what are the best funds and what are the best funds that we can reasonably get into. And that's going to be a very important discussion.
Great.
Okay, thank you. So now we have item 8.
George,
Oh, I'm
George's
sorry,
in the queue.
George in the queue. Pardon me, George.
Yeah, I don't have, I agree with this decision, but I'm just playing catch up. Could you explain the trigger or the rationale that decided was it opportunistic because of the price, or is too much of a headache to manage these properties, or?
It was a bit of a staff burden to manage these property, or not manage them, to oversee this
Right.
program. It more so was a play on reducing the risk of the portfolio. Due to the size of these properties being smaller in nature, they were more volatile. A hurricane goes through South Florida, it could really impact our property. As opposed to putting our money into a core open-ended fund, which has hundreds of properties,
Right.
and they're much larger in scale. So they're not subject to the ups and downs.
So better diversification,
Absolutely.
less headache for managing it.
Yes.
Okay, thanks.
Okay, number 8.
Going on. Okay. This is the summary of the independent review of the custodial bank fee structure. This item was included on the fiscal year 2017 action plan. Although SDCERS regularly conducts requests for proposal for custodial banking services every 3 to 5 years, this does not allow, am I in the wrong one?
Are we on investment division policy and procedures?
Did I skip one?
I think we skipped something.
Oh, I'm sorry.
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 Independent investment division policy and
Sorry, I
procedure.
have 2 reviews back to back.
I know. Too many
Skipped,
reviews.
I went too far. Thank you. So this is the summary of independent investment division policy and procedure review. This was also included on the fiscal year 2017 action plan. And although the investment policy statement is reviewed and updated as needed annually, none of SDCERS policies or procedures had been reviewed by a third party. K&L Gates, SDCERS Investment Legal Counsel, was engaged to conduct this review. They reviewed many documents, many of our policies, and our procedures, although most of the review was focused on the investment policy statement, since that is our most comprehensive investment policy. The findings from K&L Gates were positive. They found that the IPS is well-grounded in fiduciary principles and reflects many best practices. As part of the review, K&L Gates did make some recommendations, and those recommendations have already been approved and included within the investment policy statement that was done at the September 2016 board meeting. Most of those changes were made to the investment philosophy and investment goals sections of the investment policy statement. During the course of the review, K&L Gates also identified the need for an insider trading policy, which was previously approved, and they also are recommending some changes to the conflict of interest policy, which I believe you'll be covering later today.
But technically, I think that policy is on the consent agenda with B&G, right?
Correct.
So it hasn't been
Yes.
approved yet, but by the full
Will be,
board
yes.
will be.
And with that, I can answer any questions that you have about that review.
Question? No questions. So now the custodial bank fee structure.
I was excited about the banking.
So exciting.
So summary of independent investment division policy. Summary of independent review of custodial bank fee structure. Although SDCERS regularly conducts request for proposal for custodial banking services every 3 to 5 years. This does not allow staff the visibility to see how SDCERS fees compare to its peers. Staff identified a company called Amices to conduct this review. Amices is an independent, conflict-free company that only provides services to institutional investors. This allows them to remain completely objective in their analysis. And Amices analyzed 5 different areas of the fees and compared these to a peer group consisting of 19 other institutional investors. The findings were very positive. The majority of the fees are below the peer average. There are, however, some areas for improvement. Staff is aware of these areas and will seek to renegotiate these areas during the next custodial bank search process. And with that, I can answer any questions that you have.
Okay, no questions. Thank you.
Staff reports?
And now we have staff reports.
Very quickly. The reconciled market value of assets as of the end of March was just over $7.3 billion. Since the prior board meeting, 6 wires totaling $6.2 million were sent from the custodial bank to SDCERS operating account at Wells Fargo for the payment of lump sum payroll payments and operating expenses. 2 wires totaling approximately $74.5 million were sent in March and April from the custodial bank to SDCERS operating account at Wells Fargo to pay monthly benefit payments to retirees and beneficiaries. Staff did initiate a rebalancing action to raise cash for monthly benefits and fund capital calls for the remainder of fiscal year 2017. A total of $80 million was raised, which was split evenly from U.S. and non-U.S. equities. The cash is currently being overlaid to SDCERS strategic asset allocation. And with that, I can answer any questions that you have.
There appear to be no questions, so thanks very much. And that was an hour and 8 minutes, Mark.
Good job.
Thank you, Carol. All right, I think that brings us to business operations, but we are approaching 10 o'clock. Is there a desire to take a break, or shall we push through? No? Yes? All right. We're going to take 5 minutes, and then we're going to come back and dive into the rest of the agenda.
It's during the day?
No, it's in the evening.
Oh, good, because I have I had everything in order. Mark screwed up my order.
There's a full open host event. I've been in charge of
I wrote it down.
lots of wine by the end of the day. Perfect.
Is that right? Actually, I didn't write that down here. Darn it. Too many numbers. 9, 1.
Well, let's see, myself, Corinna, and she's, works on she's in the Treasury Department at Sempra.
Just so you know.
Himself in the queue.
I'm kind of into that. I got to be honest with you. All right.
TMI.
I want to see a big smile on my face. You might just the governor on his mouth.
David, can you hear me okay?
He just joined.
Okay, you're not going
Jeffrey,
yet. Can you hear me fine?
who you heard from, and then Bill Wiener, who's not here, and he's in another
David, can you hear me?
appointed trustee like myself.
Yes. Bad bottom
Oh, there you go. Okay. Hold on. You're gonna, okay.
And then
Can you hear me?
also
It's Cynthia.
pretty sure this board.
Okay. No, I couldn't, but now I can. Okay, just hang on. Your item's going to be after the one we're about to do, but we just figured to just have you hang on the line until we're ready, okay? Okay, don't go away. Just hang on. Thank you. Yes. Okay, let's get you one today.
This was yesterday for $28.
I'll take care.
Charge it, you'll take care of it.
I sure will. There you are for today.
Or two?
Did you have your other one to get out? Okay.
We got some really smart people helping us, though.
Okay.
How old?
That's why the
Val?
Because that is really.
Pointing out girls, right? Girls. Oh, yeah.
Where's come in?
We just got them on the line already. Yeah, and hanging out.
Congratulations. Yeah, they did this fast.
All right, we're back, except Jeff. I'm going to give him a chance. All right. We are back in session, and we are on new business, under business operations. Mark, do you want to address item 1 there?
Yes. With Alan's departure from the board, he's now completed his 2-year term. Actually, Val is assuming that role for today's meeting only. But our normal board process is in May of every year to discuss the election or re-election of a new board president. So our process is at today's meeting to form a nominating committee of 3 people or so to meet and discuss amongst themselves potential candidates for the board president office, and then to bring that recommendation back to this board at the July meeting for a board president. And then whoever that person is elected in July would then come back in September with his or her recommendation for a board vice president, which is voted on in September. So the item today is to find a set of people to serve on this nominating committee, and I'll turn that over to Val.
Sure. So my understanding is that as the temporary interim quasi board president, I actually appoint the nominating committee from the board, and then we vote on it, or?
You can look for volunteers or ask people to serve on that. Well, there's one volunteer right there.
Who would like to serve on this committee? All right, Carol, Tanasi, Tom, and Karina. Can we have an even number?
You can.
Well, then I think we should.
I'm not enough for the committee, it's fine.
Committee meetings just got longer. All right. Anyone else want to serve and make it an even 5? Jeff?
I think that's a no.
All right.
Business hours.
So Tom has volunteered. So I like a 5-person committee. So I would make a motion to approve the formation of a nominating committee for board president consisting of those 5 volunteers.
Okay. Do we need to have them in the,
No, that's fine if we have. I know who they are. The minutes
Okay.
will reflect that.
okay.
All right.
Do I want to put consistent of 5 volunteers on here, or just leave it the way it is? Okay.
I think the chair can be appointed by the committee. Tanasi asks a good question, which is, should we designate a chair in the motion as opposed to having the committee then meet and select one of their number? I don't know that it makes much difference, but Tanasi's doing a lot of talking.
Yeah,
And so I would nominate Tanasi to be the chair of that committee.
Okay, that's also fine. Yeah, that should be part of, yes, that should be part of this motion, is that you form
All
the
right.
committee and a chairperson. So that would be great. Thank you.
All righty. Sorry. All right. If the minutes reflect it, I could probably just push the button on the existing.
How about that?
All right. So I've made the motion for the formation of that nominating committee with Tanasi Priovalos as chair, and Tom Sullivan's provided the second.
Ready to vote? All votes are in.
All right, and that carries 12-0. Thank you, volunteers. And that brings us to the item 2 on the agenda under new business, revised PSC calculator and rates for purchase of service credit effective July 1, 2017. And I understand, in addition to Alice, we have David Holland on the phone from Chiron.
Yes.
The floor is yours.
Good morning. Thank you for having me. So we have David on the line as well, as Val mentioned, and today I'll be going over our presentation on the update to the purchase of service credit rates. We'll take a look, a little bit of background just to understand the rates, where they're coming from, how they look now. We'll review what changes, what the updates were that required a change to the rates, and then open it to any discussion that you may have. So members of the city, port, and airport are allowed to purchase service credit. And the city is, members of the city hired prior to July 1st, 2005 are still allowed to buy what's considered airtime for service. Otherwise, the port and airport and all other city members are allowed to purchase service credit for any other qualified purchases, such as leave without pay or long-term disability service for that nature. Now, years ago, the purchase of service, the PSC rate was just a flat rate. And since then, it's evolved and become much more specific. And we have rates set for every age in service, plus every tier, every plan that the member, for each member. Now, as opposed to providing SDCERS multiple rate tables, what Chiron does is we provide a calculator program, and that calculator program has all the rates for each member, each age service combination. And this calculator now happens to be embedded in IRIS from the rates that we provide to SDCERS. Here's a sample of the face of this calculator where SDCERS staff enters information into the top section, into member information, and then the results of the calculator tell the cost of purchasing that given amount of credit. Now, this is always a fan favorite, the formula for this calculator. The idea behind the calculator is to keep the cost neutral to the system. So when you're buying credit, you're paying for the added value of that benefit of that credit, plus any contributions that would have otherwise been made to the system had you actually worked those years and been contributing as a working employee rather than purchasing those years.
For our newer trustees, we had a previous trustee who was a chemical engineer, asked questions about the formula, wanted to see it. So we put this chart on the deck, and he said, I understand that, it makes sense.
So, and these rates that are calculated, it's a rate that's based on a percentage of current salary. So a member who's purchasing service, it's the rates that you'll see, it's multiplied by the salary for the total cost of the purchase service contract. Now, we came to you last year and we updated rates to the PSC calculator, and we're coming before you again this year to update those rates again. And the reason being, whenever there are changes in assumptions, the rates, the cost of purchasing this service changes as well. And so last year, we saw with the June 30, 2016 actuarial evaluation, we had many changes. There was the change to the discount rate and the inflation assumption, as well as the other changes from the economic experience study. And we saw mortality was one of the big drivers in the change of costs in the actuarial evaluation, and that flows through to these purchase of service credit rates, that it also, mortality is one of the main drivers in the increase in cost of the rates of the PSC. And these new rates will be effective July 1st, 2017.
Quick question.
Yeah.
This only applies to employees that were hired before through 2005, I believe, is that correct?
For a specific type of purchase. So members of the city are still allowed to purchase airtime. So it's the 5-year airtime that they're allowed to purchase any portion of 5 years to add to their service for, not for service missed, but just airtime service as it's called. Members of the port and the airport, because of the implementation of PEPRA, are no longer eligible for this airtime purchase. And also city members hired after 2005 are not eligible for this airtime purchase. But they're still eligible for leave without pay if you go out on disability leave, other such qualified time.
So that number is getting pretty small then?
The number is going down. I don't know how many contracts SDCERS processes every year. We do receive the data, but I don't have it off the top of my head when we use it in our valuation.
Cynthia might be able to answer that.
I was just going to add that there are still a couple thousand people who are able to do so because of the population at the city who was hired prior to 2005, such as myself. So the number is definitely decreasing, but I was looking at these statistics as I was updating a feature on our member portal that allows people to calculate this information.
Surprised. Thanks.
As
Thank
far as the volume, that's one of the things that I report out each board meeting to you. So the last 2 months, last month we processed 38 purchase of service applications, the month before that 54, the month before that 43. So there still is a significant number of applications that come through, but the number of the 5-year purchases has significantly declined.
Thank you.
Now, the remainder of the slides just go through each plan sponsor's tier and show in the top graph the current rates for the purchase of service rates, and the bottom are the proposed rates. So those are the rates that you'll be approving today and would be effective for July 1st, 2017. For this slides, we break it down into 5-year age and service increments, but in reality, the calculator has rates for every age and service combination. And then when a member's age and service is entered into the calculator, we actually interpolate to the exact age and service for that, for the value of their contract for the service that they're
These are
buying.
ranges, but that's not how it's actually applied.
So what you see here is, right, the 5-year increments, but it's, in reality, it's a full by every age, every service, and then you're honing in and interpolating to get the exact value. So we will not go through each of these slides, but rather if anyone has any questions on any of the any of the rates or anything?
I have a question. I was just curious, has the plan saved money by ending the purchase of service credit program, even if it's minute?
So over the course of the valuations that I've seen, prior to the refined calculator, that I can't even remember if we refined the calculator. It's been maybe even 2008 when it went into the detail of at the level of detail that we have now. We used to see a small gain or loss due to these purchases, but now that's that line item in the backroom work that we do has really been minimized because these go ahead.
I'll try it a different way for you, Jeff. So in 2003, we changed the rates to be cost neutral for members. So from 2003 to 2008, everyone paid the flat fee that Alice mentioned earlier. An aggregate, it was cost neutral. But you could say some people overpaid, some people underpaid, depending on how old they were. So in 2008, we went to the age and service-based calculator, and since that time, it's been dialed in an aggregate and individually, they are both cost neutral.
So the line I remember back then when they ended this program was they were saying it's not cost-free, and that was the reason they ended it. And I was just wondering today if that remained true, and it sounds like...
That may have been more, what you just mentioned there may have been more applicable to the DROP program.
Oh.
Because there was a study that Buck Consultants did on behalf of the city and came back with that conclusion.
Okay. Thank you.
And that concludes my presentation. If there are no more further questions. Thank you.
All right, so we need a motion to approve. Motion's been made by Carol Broad, second from Tom Battaglia.
Ready to vote? All votes are in.
All right, and that is unanimously approved. Thank you very much.
Thanks, Alice.
That brings us to item 3 under new business. Susan Youngflesh will come to the podium. This is a staff's recommendation to deny Marianne Toomey's request for reconsideration of the board's granting of her appeal to waive interest but not principal on overpaid benefits. We have a speaker on this, which is David Toomey. So, Mr. Toomey, if you'd like to come up front and sit at the microphone. All right. As soon as Mr. Toomey's seated, Ms. Youngflesh, you will have the floor.
Thank you. Thank you. So at the last board meeting, the board granted waiver of Ms. Toomey's appeal of interest but not principal on overpaid benefits. Ms. Toomey now seeks reconsideration. So as a bit of a recap, Ms. Toomey is the former spouse of general retired member David Toomey. She was overpaid benefits. She sought waiver of the interest of $17,500, and a couple days before the last hearing, she then requested waiver of the principal as well. All the facts were before the board, including a 2002 handwritten note showing that staff knew of the error. The board granted the waiver of interest of $17,500. So for a request for reconsideration would normally be appropriate if there was some sort of fraud or new evidence. There is nothing new in this case. Before even entertaining a discussion, there has to be a movement and a second from a trustee that voted to grant the appeal of Ms. Toomey. Otherwise, this dies for lack of a motion. Staff recommends that the floor is not opened for discussion, so there would be do I hear a movement or in a second?
I don't believe there's a motion or a second. But we have Mr. Toomey in the queue, and so that raises a question that I'd like probably to address to Johnny, which is whether it is procedurally appropriate to allow Mr. Toomey to speak in light of what Ms. Youngflesh has just said.
Well, this is an open meeting, and so he could speak on any public item. I would invite him to speak. The issue is if you open reconsideration, then it becomes a discussion, and then further, you could further allow him to speak. But I would allow him to speak on this item even before any motion is given.
And if there is not a motion that is seconded, should the board chair allow discussion, or should there be no discussion at that point?
There should be no discussion if there isn't a first and a second to reconsider the item.
All right, thank you. At this point, Ms. Youngflesh, if you have nothing further to add, I'm going to invite Mr. Tomey to speak.
Yes, nothing further.
All right, great. Mr. Tomey, the floor is yours.
Okay, thank you. There is a handwritten note in the file, and I personally requested a copy of the file because all of this sounded strange to me. And inside the file, I found the handwritten note. And so there is a statute of limitations upon the discovery of the overpayment. And the handwritten note's from 2002. So we had 14 years of delay. And the meters was still running for 14 years. And so I don't think you people understand. There is a statute of limitations, and it's 3 years. It's doctrine of latches and estoppel. So equitable estoppel. And I believe it was unfair. There was the handwritten note, and no one ever mentioned it, and it was up to us to order the file and find it. And so they say, we found it. No, I found the handwritten note. And it was like 10 days before the final bell. And so I never got an accurate hearing on this. And I am going to go to court and get damages and punitive damages. So you don't do this to some other old 80-year-old lady. My mother's 80 years old. She did everything right her whole life, and then she gets this giant bill that was just bullshit. And you guys know it. And that's all I have to say. I'll see you all in court.
Thank you, Mr. Tomey. At this point, does anyone wish to make a motion? All right. Then this matter is ended. There is no motion and no second to open discussion.
Thank you.
Thank you. All right. That takes us to a non-action item, which is annual fiduciary training. Chris Waddell, our fiduciary counsel, is here to provide that to the board.
Thank you, Val. If I may introduce the training. So each year, the board has provided fiduciary training. This year, the training will be handled by your fiduciary counsel, Christopher Waddell. Chris is a senior attorney at the law firm of Olson, Hagel, and Fishburne in Sacramento. He's been your fiduciary counsel since 2012. Prior to private practice, he was general counsel of SDCERS and SDCERS. So he's a real McCoy, and thank you so much for being here today. Thanks, Chris.
Not at the same time, though. Good morning, everybody. I appreciate that it's already been a long morning, and you've still got a lot on your agenda. But I do hope that from throughout the presentation, you'll feel free to interrupt me with questions. These discussions are a lot more, I think, useful if there's give and take between the board members and your presenter.
Chris, you take as much time as you want. I'm still online shopping for my wife for Mother's Day, so you go right ahead.
We're going to get to that part of the
Okay,
presentation, Vanassi,
okay,
just a
good,
couple
good,
of minutes. So some of you have, most of you, I think, have heard at least one presentation on fiduciary law from me, fiduciary duty. A few of you are brand new. Congratulations. And so this will be your first time. What we're going to start off with is an overview and refresher of the duty of loyalty and the duty of care. Again, for those of you that have heard this before, it'll sound pretty familiar. We're then going to move into the primary focus of this presentation, which is the duty of loyalty and what's called the two hats rule. Two hats rule may be roughly characterized as, quote, what am I supposed to do when there's an issue before my board that will impact either the plan sponsor that appointed me or the member or the general constituency that elected me? And sometimes, to add flavor to it, the appointing power or the electing authority is attempting to influence your decision on a given matter. We're going to then take a quick detour into the issue of intergenerational equity, which, as I understand, was a discussion topic that came up during your recent offsite. And then we're going to conclude with a review of the CalPERS 8 questions, which we've covered before, I think more than once. They're a tool that's available to help you get comfortable with your votes reflecting your duties of your duty of loyalty and your duty of care. So that's where we're going. Your applicable fiduciary duties, all of this is straight from the California Constitution. The Constitution organizes all of the duties up there, and again, that's duty of loyalty, duty of care, duty to diversify investments, duty to provide for actuarial services. There are separate sections in the Constitution. There's also a duty to administer the plan, which I don't have up on the slide. But I think that just to try to keep things as simple as possible, it's easiest just to think in terms of the two main duties being the duty of loyalty and the duty of care. And as it shows on the slide, the duty to diversify investments and the duty to provide for actuarial services really kind of run under the duty of care. Duty administer sort of covers both, and we'll cover that a little bit more. We'll kind of switch up the order. Duty of loyalty is usually what we talk about first, but since we're going to focus, really do a deep dive on that today, we're going to do a quick overview of the duty of care first, and then go into duty of loyalty. So this language, again, is straight from the California Constitution. I recognize that there are a lot of words on this slide, and I think sometimes it helps to break down the duty of care into 6 parts. Care, skill, diligence, and prudence. All of those words give you the idea that this is a pretty exacting standard. Under circumstances then prevailing, in the immortal words of Marvin Gaye, what's going on? Prudent person. Prudence is defined as care and thought for the future. Acting in a like capacity. Who are my peers? Well, lots of retirement systems in California operate under the same duties, the same responsibilities, same fiscal environment, all of those things. And usually there's someone else you can look to say, well, how are they doing it? Is that what we should be doing? Should we be doing something different? If we're doing something different, is there a good reason for doing something different? Those kinds of questions. Familiar with these matters. Now, that's a code word for expertise, and we'll talk more about that in a moment. Would use in the conduct of an enterprise of like character and with like aims. Again, what systems are like ours? So the Constitution breaks out the duties to diversify and to provide for actuarial services as separate duties. As I said, I think it's easier to remember these as being part of the duty of care. The duty to diversify comes straight to California from the language of ERISA, which applies to private sector retirement plans. The duty to provide for actuarial services comes to us because of 1991 legislation that gave the power to appoint CalPERS as actuary to the governor. Now, that legislation was challenged in court and upheld, but the legislature was never able to confirm the governor's choice for actuary, and subsequently Proposition 162 was placed on the ballot and passed in 1992 in direct response to that court decision. And that's Proposition 162, among other things, is what added the duty to provide for actuarial services. So if you're wondering why in the heck do they have something about actuarial services in the Constitution, that's why.
Chris, what was the concern with having the governor appoint the actuary that led to the proposition?
Well, there are a number of concerns. I guess in the interest of full disclosure, I should indicate that I was Governor Wilson's labor lawyer at the time, so I had a little bit of a hand in that particular legislation, and we were all kind of surprised, litigation, and we were all kind of surprised that we won. The short answer is, with specific respect to the actuary, it was viewed as a usurpation of the CalPERS board's responsibility to administer the system. There was also there was transfer of funds from a surplus account in CalPERS to cover currently do employer contributions. So that was viewed as a pension rate. And actually, if you look at the legislative history, the ballot language, the primary focus is on pension rates, although there's a lot of language that reinforces the both the responsibility and the obligation and the independence of public retirement systems to administer the system. And also, we'll talk about this in a little bit, they added specific language to the duty of loyalty that makes it clear that the duty of loyalty is the primary fiduciary duty in California. So the duty of care, this is going to be a pretty quick flyby, but please feel free, especially the newer members, to interrupt me if you have any questions about it. When all is said and done, the duty of care is all about process and information. Follow a prudent process, get the necessary information, secure the necessary outside expert advice, ask questions, etc. And I'm giving it a little bit short shrift now because actually a good chunk of the CalPERS 8 questions that we're going to cover at the very end go to those very questions that would help reinforce the kinds of things that need to take place in order to satisfy yourselves that your duty of care has been satisfied. Now, some of my peers make a big deal about whether trustees are subject to a prudent expert or a prudent person standard, and the actual answer varies from state to state. In California, technically, there's no question that California pension fund trustees are subject to what's called the prudent expert language. Why? Because the language in California's Constitution was borrowed directly from ERISA, which is considered to be a prudent expert standard. It's the magic language that I referenced a couple of slides ago, quote, familiar with these matters. I think in practical terms, it's a distinction without a difference. Under either standard, unless the board construct contemplates an all-expert board, and in California we don't have any of those, at least yet. We certainly have some boards, including this one, that provides specific areas of expertise. But the duty of care, absent an all-expert board, is going to require the engagement of expert consultants, such as investment consultants, investment managers, actuaries, and I'm sorry, even lawyers. But it's really not enough to simply hire experts. As board members, you need to prudently select and delegate to your experts and ensure that proper mechanisms in place to monitor and review their performance. That's it on duty of care until we get to the 8 questions. Are there any questions about that before we shift to duty of loyalty? Okay, great. Duty of loyalty is what I call the big kahuna of fiduciary duties. This language, again, is straight from the California Constitution, and the touchstone is really that last sentence that's in bold. And by the way, as I mentioned a couple minutes ago, that last bolded language is also language that was added by Proposition 162 in 1992. Now, I have a series of slides that I use for other presentations when I do out of California presentations that addresses the question of what happens if the application of duty dictates one result, but the application of the duty of care dictates a different one. The answer, after reviewing the findings of a fiduciary expert that cites, among other things, Immanuel Kant's philosophy of perfect and imperfect duties, is that in the event of a conflict between the duty of loyalty and the duty of care, the duty of loyalty prevails. Again, in California, there is no question about which one comes first because that bolded language is what drives that answer. So what do the courts say about duty of loyalty? You cannot sit through a lecture or presentation on fiduciary duty from myself or from any of my peers without seeing this very famous quote from Chief Judge, who later Supreme Court Justice Benjamin Cardozo. I love the word punctilio. It makes a point because the definition is minute detail of conduct in observance of a code. And in my view, in conjunction with an honor the most sensitive, it drives home the import of the duty of loyalty. As I've said here before, please do not confuse the word punctilio with peccadillo. They do sort of sound alike, but trust me, they mean entirely different things. I really like this image of Justice Cardozo staring down at all of us as we grapple with difficult issues while trying to keep the interests of members, retirees, and beneficiaries in the forefront of our minds. Excuse me. You will hear this statement time and time again this morning, and anytime you hear a presentation on fiduciary duty, board members must place the interests of system participants above all other interests. Going back to philosophy just for a moment, Kant divides duties into two categories, perfect and imperfect. Imperfect duties are ambiguous and open-ended and generally require you to do something. Negative duties are unambiguous and require you not to do something. Viewed in that way, the duty of care, which we flew over at 30,000 feet a few minutes ago, is an imperfect duty, while the duty of loyalty, conversely, is a perfect duty. You can think of the duty of loyalty as being very analogous to the Hippocratic Oath, i.e. primum non nocere. Yes, I did take Latin in high school at Francis Parker, although I've apparently forgotten the pronunciation, or first do no harm. So looking at this slide, here are the don'ts. Don't self-deal. Don't engage in prohibited transactions, including those that favor the interests of the plan sponsor, unions, or a third party over the interests of members, beneficiaries, and retirees as a whole. And where possible, don't favor the interests of one group of members and beneficiaries over those of another. And what I just said there refers to what's called the duty of impartiality. We're going to focus today on the second don't, acting in the interest of the plan sponsor or a third party, and what's called the two hats rule. The exclusive benefit rule is, again, stated separately in the California Constitution. I also think it works best to be viewed as a corollary of the duty of loyalty. Again, I think it helps just to try to keep two duties in mind, duty of loyalty and duty of care. If you add up all of the duties in the California Constitution, it's like 6 or 7, and that's really hard to keep track of, so I try to keep it simple. So all of this language is straight from the Constitution. The first and third bullets really seem pretty self-evident, but what's this about minimizing employer contributions? It can engender some confusion and has engendered litigation. The bottom line is that you can't look at minimize employer contributions in isolation. You can look at it as sort of an all else being equal test, i.e. if board action gives precedence to the interests of the system's members, retirees, and beneficiaries, and also results in minimizing employer contributions, then it's okay. Conversely, if the decision to reduce employer contributions is not motivated primarily by what's in the best interests of system members, beneficiaries, and retirees, then it's not okay, and that's really the holding in the City of Sacramento case, which is cited on that slide. Virtually every retirement system in California has a mix of members that are either elected by active or retired members, approved by the plan sponsor, or sit ex officio by virtue of holding another public office, which is often elective. It's not uncommon for elected members to also be elected union officials. It's not uncommon for appointed or ex officio members to have day jobs where they manage human resources or budget functions that are directly impacted by retirement system issues. The two hats rule says this is okay as long as when you're wearing your board member hat, you make decisions that, again, are with the sole focus on what is in the best interests of members and beneficiaries and retirees of the system. Some of you, or certainly individuals at other retirement systems, may have more than one hat. One system, I have an ex officio board member who is also a department director and also a member of the plan sponsor's negotiating team. And trust me, those latter two hats are very different hats if you worked inside a public agency. For our purposes, we're going to keep it simple and assume that we just worried about two hats, your non-fiduciary or day job hat and your fiduciary and your board member hat. What we're trying to do with this slide is lay the groundwork for distinguishing between the times when you're wearing your non-fiduciary hat and your fiduciary hat. And it largely, not entirely, but largely comes down to the question of, are you running the plan or are you designing the plan? If you're running the plan, you're acting as a fiduciary, and you're designing the plan, you're probably not a fiduciary, although there's times when that can overlap, and we'll see an example of that in just a moment. In my experience, most trustees, be they an elected member who is also an elected union official, or the head of a labor relations for the plan sponsor, or an ex officio member serving by virtue of holding an elective office, are extremely conscientious about the idea that they wear different hats at different times, and they've got to think solely as a fiduciary when they're wearing their board member hat. And sometimes it's easy to make the distinction to understand which hat to wear at what time, and sometimes it's not, as we'll see. Before I get to an example from outside of the California, you might be wondering why are all these circles? And there's really a specific situation that's come up more than once where the idea of plan design and plan administration kind of overlap in a way that really presents an issue to resolve. And that is in situations, there are some systems, some in California, some outside the state, where the employer contribution, actually all contributions to the plan, are set by statute. And there's no ability of the retirement system to adjust plan contributions to the plan at all. And in that situation, two plans, one in California, one outside of California, found themselves in a situation where without change, including potentially increased contributions, the system is going to run out of money in a pretty short period of time. And both systems confronted the question of to what extent do they need to become involved in actually proposing a solution to that issue. The two systems took different approaches. One system, actually, a law was passed that directed the system to develop and recommend a solution. The other system took the position that they needed to serve as a neutral broker of information and not become involved in actually recommending a solution. The concern with recommending the solution is that inevitably was going to put them in the position of making recommendations that were going to hit different groups of their membership differently. So there's no right or wrong answer to that. The only point of this slide is to indicate that sometimes there's not a clear division between plan administration and plan design. So here's an example of wearing the wrong hat. This one's pretty easy to look at. Let's look at the comments by the Colorado State Treasurer. In the very last line, he says that his role is to serve on the Colorado PIRA's board as a voice for taxpayers. Note the second bullet. As a fiduciary, he asserted that he was entitled to complete access to all PIRA records, but wouldn't say what he planned to do with them. The courts found that the Colorado State Treasurer was unclear on the concept. And as I said, this case is actually a pretty uncomplicated example of wearing the wrong hat. The court clearly stated that fiduciary duties do not extend to the public at large and instead flow solely to the system's members and beneficiaries. Please note the first bullet. The courts found that the state treasurer was subject to the identical fiduciary duties as other trustees, and that's pretty much a universal truth for all public pension fund trustees. So we're going to make it a little bit harder. Boards facing a decision that has the impact of increasing or decreasing required employer and/or employee contributions to the plan, which is a scenario that's becoming increasingly familiar in California and as well as across the country. Two hats issue can present itself in a much more complicated ways like this. Everyone that becomes a public pension board member assumes their position holding their own day job with its responsibilities and associated stress, their own personal beliefs and values about what's best for the plan sponsor, the public at large, and/or for a specific subset of retirement system stakeholders. It can be hard to keep those things from affecting decisions made as a public pension fund board member. However, going back to the Constitution's description of the duty of loyalty, when making decisions as a board member, you must consider solely what's in the best interest of the system's members, beneficiaries, and retirees as a whole. So, there are a lot of variables in this. Are you wearing your board member hat or your other hat? When you're wearing your other non-fiduciary hat, you may make decisions in your day job that may not be in the best interests of system members, beneficiaries, and retirees as a whole. But when you're wearing your board member fiduciary hat, you must make decisions based on what is in the best interests of the members, beneficiaries, and retirees as a whole. You need to constantly ask yourself that very question: what's in the best interest of the system's members? And it's in smaller type on the slide, but it's really important, and it's italicized and bolded for a reason. Pension board members do not serve as agents of an employer, union, or other constituency that appointed or elected you. That's not the job. So, on-plan funding issues, such as one we just discussed, wearing your fiduciary hat, you can take into consideration factors that you reasonably and prudently conclude would affect the interests of the system members, retirees, and beneficiaries as a whole, including what's the system's short-term cash flow and long-term funding requirements? What's the plan sponsor's ability to meet its current and future obligations to the system? To the extent that a change would result in an impairment of the system's short-term cash flow and or long-term funding requirements. You can also consider the interests of active members in keeping their jobs to the extent that job losses would impair the system's short-term cash flow and, again, long-term funding requirements. Before I move to intergenerational equity, are there any questions about what we've covered so far? When I first started hearing the term intergenerational equity being used in the public pension milieu, it was most often being used by those seeking to eliminate or substantially reduce existing defined benefit plans. The argument went something like this: because of high unfunded liabilities, under current actuarial practices, there's no way that the costs of benefits will be paid for entirely by the current generation of taxpayers, and inevitably costs will be paid on to the next generation of taxpayers. The problem with that line of thought is that the adopting funding practices that would eliminate that possibility would in many cases create such a high actuarially required contribution that no plan sponsor could reasonably afford them. And it was pretty obvious that some of the folks putting forward this concept clearly understood that. But regardless of where one stands on the policy issue, in my role advising public retirement systems on fiduciary duty issues, because the argument was taxpayer-focused, I didn't pay much attention to it. It was framed as a taxpayer fairness issue, and as we've discussed, public pension system board members must act in the best interests of the system members, beneficiaries, and retirees, as opposed to the interests of taxpayers. Now, I understand that the board had a long discussion about intergenerational equity at its offsite last year. Coincidentally, I'm actually getting more and more questions about the topic. What I like about this language from the GFOA Best Practices Report is that it brings together the issues not only of taxpayer fairness, but also benefit sustainability. And benefit sustainability, as we'll discuss, gives us something meaningful to think about in the fiduciary context with respect to intergenerational equity. I've got a couple of quotes on this slide. One is from the Bant case, which we'll talk about a little bit more in a moment. It's true that the statement on the first bullet, there's nothing in Section 17, Subdivision B of the California Constitution, again, that's the parts of the Constitution that talk about fiduciary duty, that would require the board to act in a manner consistent with the principle of intergenerational equity. The quote, however, was immediately preceded by this language. The appellants claim that the board's action conflicted with the principle of intergenerational equity, i.e., quote, calculating and receiving during each fiscal year contributions which, expressed as a percent of active member payroll, will remain approximately level from the present generation of citizens to the future generations of citizens. Now, in Bant, the court, as indicated by this language, went on to reject the argument that the pension board action that was at issue was inconsistent with intergenerational equity of citizens and taxpayers violated the Constitution. So in that context, it was the context of the impact of intergenerational equity on taxpayers. Bant said, no, that's not a consideration. Bant does not stand for the proposition that you don't have to think about intergenerational equity at all. What Bant did not address is whether and when intergenerational equity could impact the fiduciary obligations owed by a retirement system to its members, retirees, and beneficiaries. That's why I like the second quote from the Colorado PIRA so much. Colorado PIRA frames the issue as being one of equal fiduciary duty to a newly hired member on the one hand and a long-term retiree on the other. There's a proper focus on benefit sustainability, the impact of members and of retirees. And actually, I like it also because there's a clear nod to the duty of impartiality included in that quote.
What gets tricky is how would you apply that to a system that's closed to new employees?
You're not entirely closed.
That was the escape valve I thought you might take.
You know, the idea, just kind of stepping back for a second, is that the plan is supposed to be run so that it's going to be there to provide the benefits for everybody that's a member. And you can't just look at making sure that the short term is covered. You have to look at the longer term and what's the better way. Now, if you were just to focus on what's best for the members, what's best for the members would be to get enough money to be fully funded like right away, and so there's no question of actuarial soundness and all of those good things, but that's not practical. It's like basically asking someone to pay off their entire mortgage in a year or two. So there's a balance in there, and I think that's what you have to take into account when you look at this issue. Intergenerational equity, I think, is, at least from a fiduciary perspective, is going to be viewed as one thing, one spice to stir in the mix of the fiduciary duties that we've been talking about.
Chris, is it also relevant to consider taking actions that will preserve and maintain public confidence in a public pension system because of concerns about political risk that exist, or should that be ignored?
You know, I guess not ignore and not make decisions based on it. I think there's a mindfulness. What's interesting is that if you read the fiduciary duties in an absolute way, you almost have this ivory tower approach, and that's not real. You know, I used to be a labor lawyer, and we talked about whether or not you could have, quote, laboratory conditions when you're running labor elections. Well, you can't, but you've got to try to do the right thing, being mindful that there's other issues going on. So I think it would be a mistake, on the one hand, for let's just take two extremes. Retirement board decides that what they're going to do is politically going to create issues and decide not to do it. That's a problem. As I said in one of the prior slides, conversely, retirement board is considering whether or not and under what circumstances to make, the obvious example is changes in either actuarial assumed rate or mortality that's going to result in significantly increased contributions. And should they, in that situation, consider the impact on the employer? Not because the employer is saying, look, we're not going to be able to fix potholes, because there's fairly clear case law on that, but the employer, there's a real risk that if you go too far too fast, it's going to create a potential insolvency or layoffs or other things that could actually impact to the detriment of the plan. You can try to do too much too soon and actually hurt yourself as a plan, and the idea is you've got to strike that balance.
Thank you.
That's it on intergenerational equity. I can't say that 3 times fast. We're going to keep moving in sort of the same area, but are there any specific questions about that before we go on? Okay, great. So where are we? If an action is in the best interests of members and beneficiaries and retirees as a whole, it's okay, even if it also benefits a plan sponsor or active employees. BANT is a great example of this principle in action. BANT involved a situation where the retirement board conducted an interim evaluation after receiving the proceeds of a pension obligation bond that reduced employers' contributions. And the conduct by the board of that interim evaluation was challenged as a violation of the board's fiduciary duty of loyalty. And the court said no, it did not violate the duty of loyalty, even though it saved the employer money because funding the retirement system was strengthened and active member jobs were preserved. Conversely, if an action is not in the best interest of the members, retirees, and beneficiaries as a whole, it's not okay, even if it benefits a plan sponsor or active employees or both. And really, when all is said and done, it's been a while now since San Diego became known as Enron by the Sea, but a little bit bears repeating here. Back then, there was a near total overlap of the SDCERS board membership and the city human resources and budget offices and union presidents. The SDCERS board meetings at times effectively became an extension of the collective bargaining process. Their collective bargaining agreements negotiated that increased pension benefits for active members that were contingent upon SDCERS actions reducing city contributions. And the ultimate deal increased benefits immediately and decreased funding immediately. Perhaps, and there was very little, and it was found later in several investigations, very little consideration given to short-term and long-term funding implications of that action. The funding of the system subsequently dipped predictably and precipitously. There were federal state criminal prosecutions, SEC investigations, lives were literally ruined. It was a huge mess. And when all is said and done, when people ask me what happened in San Diego, I think that the easiest explanation is that the SDCERS board allowed itself to become an extension of the collective bargaining table. That is not in any way a criticism of the collective bargaining process. I was a public sector labor lawyer for years. I fully believe and embrace the collective bargaining process. But in that instance, the combination of the two, or the retirement board becoming an extension of that process, is what really created a huge issue.
Excuse me, since I'm new here to the board, could you repeat that and give me a little more color on it? It'd be a little clearer to me.
Okay. That could take a lot of time. So let me try to provide a little bit more color, and maybe if you have a couple of specific questions. The system entered in 1996. The retirement board and the city entered into a funding arrangement where the city promised to pay contributions based upon certain triggers and the like. My recollection is that a few years later, after the 2001 crash, the trigger amounts owed by the city were going to become very problematic for the city. So then there were efforts to renegotiate that agreement. And the ultimate deal that was reached was called Manager's Proposal 2. And I'm speaking very simplistically, but the basic parameters of Manager's Proposal 2 was there a certain number of benefits increases that were negotiated at the bargaining table, but they were contingent upon action by the SDCERS board to agree to a modification of the existing funding schedule for SDCERS. And ultimately, part of my personal concern, I think others have cited this, is that it was not clear to me that because they were working off of actuarial numbers at the time, there were already unrecognized actuarial losses baked into the system because losses are smoothed over a period of time. So unless the market really snapped back, there was predictably going to be a huge negative impact on the system. And unfortunately, that's what happened. The system's funding crashed. It became a big issue. And I don't know how long you've been in San Diego or what your history here is, but it became an issue for the city because the city had some issues with the SEC with respect to representations it made on its bond disclosures. That's how the SEC got involved, again, with respect to the pension funding. I don't know if that answers your question or if you have any follow-up, but that's, kind of like the 50,000-foot view of that.
That's fine, thank you.
Thank you. So as a lawyer, I always think it's a great thing when a court comes along and says the same thing that you've been saying in fiduciary training for several years. This new case, O'Neill versus Stanislaus County, looked at two competing conclusions as to why the SDCERS board, that's the Stanislaus County Retirement Board, took a particular action. One possibility was that the board took that to cut the county a break. Court said that wouldn't be okay. The other argument put forward by the board was that they took that action to prevent job losses to SDCERS board members and a resulting negative impact on the system itself. Court said that would be okay. Court said because the factual record is not clear as to which it was, you're going back to court. So in the past, I'm not necessarily sure if I've done this at SDCERS, but certainly with other presentations, I've had a slide up there and it's an actor on a stage basically saying the classic line, what's my motivation? Well, that's really what it comes down to with respect to duty of loyalty.
Chris, what was the evidentiary record? Did they use the proceedings of the board meetings like ours and evaluate what individual board members said, or?
My recollection is that the case was resolved initially on the pleadings, and so there was not much of an evidentiary record. That's why I went back to court to develop that evidentiary record. And it's about time for me to check in and see where that case is. I don't think it's gone back to trial yet, but I'm guessing it's probably going to be pretty soon.
But it may be relevant what each board member says in a meeting like this about their motivation. Is that?
Yeah, oh yeah. And I'm sorry I had that reaction because a long time ago in a galaxy far away when I was working with another retirement system, the board was considering a very difficult issue. And I would say it was tobacco divestment. And there is a very clear record that was developed that supported the divestment on the grounds that there is the consultants are advising there is a substantial risk of loss to the investment portfolio if they continue to hold tobacco stocks. A couple of board members said, well, I'm doing this because, I hate the tobacco companies, or smoking is bad, or all of those things. In other words, they posited a non-fiduciary reason for their vote. There's no reason to do that. And frankly, in that particular case, I was very confident that, clearly the board was acting based upon the investment recommendation as opposed to their personal beliefs. But absolutely, and I'm sure that'll come up in the O'Neill case. It's going to be very interesting to see how this case plays out, because I think individual board member comments, what the state of the factual record is, what was written, what they had before them, what the board member comments were, all of those things will come into play. Absolutely.
How about things that members might say when they're running for election during their campaigns? That's kind of topical right now.
It's tricky because you get into your two hats thing. I think that if you're a candidate running for something other than a seat as a board member, you have a certain amount of play. It becomes a real issue for systems that have ex officio members that are generally elected, because a lot of times board members will, people either running for office or incumbent board members who are ex officio running for office will say things with respect to their retirement system but not be saying them on behalf of the retirement system. So that's actually a second issue. So you get into, even if you're wearing your non-member, your non-fiduciary hat, to what extent can you, what you say or do, loop back into your fiduciary world? That's definitely a gray area.
So what you're saying is if we made certain statements while running for office, we should buy the secondary insurance.
I think this will play out on a national stage shortly, so.
Anything is really possible on that. So where are we? Bottom line, and wherever you heard this before, can you answer yes to this question? Does my intended vote reflect what I feel to be in the best interests of the system's members, beneficiaries, and retirees as a whole, without regard to the interests of any constituency or appointing power responsible for my position as a board member? there may well be individual trustees that are put on the stand in the O'Neill case and ask that very question or something like it. So I think that visual is something that we can all keep in mind. When in doubt, ask your lawyer. So that's the end of the two hats component of this presentation. Are there any other questions before we move in kind of like a general review?
Do we have any legislative privilege not to testify about our motivations, for example?
No. No.
I'm thinking of Section 47 of the Civil Code in particular.
I don't know the answer to that question specifically.
That's all right.
I will tell you that I've been involved in an analogous context in an entirely different life where you're in a damned if you do and damned if you don't position, because if you didn't waive that and testify, exactly. So it may be an answer without meaning, but I'm not sure about. So if you've heard me talk about fiduciary duty before, you've heard me talk about the CalPERS 8 questions. I'm not going to spend a lot of time with these today. It's already been a long morning for you. But especially for the newer board members, if you have any questions about this, feel free to ask Johnny or ask me or anyone else, because I think they're very helpful with respect to, especially a new board member who's just kind of getting into this and trying to understand what it's all about. And you know, there's no grace period. You're on the dais. You got to cast votes. You got to make decisions. So there are 8 questions. I'm not going to read each and every one of them. First one goes to, do you have all the information necessary? Second one, have you identified and analyzed all of the benefits and risks? Third one, have you identified and analyzed all of the viable alternatives? Are your staff and experts in agreement? And if not, is that okay or is that not okay? And have all your questions been sufficiently addressed? If you answer all 5 questions in the affirmative, there's a really good chance that you've followed a prudent process and have fulfilled your duty of care. With me so far? Great. Last 3. Do I have any actual or potential conflicts of interest? Where have we heard this before? Is my intended vote in the best interests of system members, retirees, and beneficiaries as a whole without regard to the interest of others? And lastly, will the decision favor one group of system members, retirees, and beneficiaries another? And here, you want the answers to be no, yes, and no. And if they are, you're likely good to go under the duty of loyalty. Why are these the right questions? We've talked about this already. The duties of care and loyalty are a constant presence in your board discussions and decisions. And as we've discussed, questions 1 to 5 talk duty of care, questions 6 to 8, duty of loyalty. And that's all I have unless you have any additional questions. Great. Thank you very much.
Thank you, Chris. All right. That brings us then to Disability Committee, and Natasha, the floor is yours.
Okay, excellent. We did have a short meeting yesterday. We had 4 items. I'm going to pull item number 4, and we'll go ahead and address that after we address the first 3 items. The first 3 items did pass unanimously. Items 1 and 2 were recommendations to approve industrial disability retirement applications for Brian Duncan and for Damon Sherman. And the item number 3 was to approve non-industrial disability retirement for Scott Spillane. So unless there are questions or comments from the committee, I'm going to go ahead and move items 1 through 3. They all pass unanimously.
Ready to vote?
We need to change the mover from Charlie to Natasha. Is it okay to do it this way?
It is okay. It's coming out of committee,
Okay.
so it's fine.
Never mind.
It's open, yeah, ready to vote. Okay, all votes are in.
Do you want to raise it?
That passes 12-0. And now we're going to address item number 4. We do have a speaker slip, Timothy Fauble, if he would like to come up to the microphone. And Susan, we'll go ahead and hear from Timothy first, and then hear from you next. Okay. Thank you for coming today, and first of all, we would like to thank you for your service as well. But you have your time to speak, so.
Yes, I received paperwork a couple weeks ago regarding this case, and relative to that information, there's some facts in this report that aren't true. I was never placed on modified duty. I was on an industrial leave, state disability. For 3 months after the state disability ran out, I didn't realize that they had stopped putting money in the bank. So that from October 3rd, from October to January, I was not receiving any income. I became opiate dependent because of this case. Sorry. I would like to just ask the board if they could reconsider this recommendation and not deny my retirement, my medical retirement. I gave 110% every day for 30 years, and I'm paying for it now. Thank you.
Thank you, Mr. Fauble. And Susan?
Thank you. I think yesterday we discussed this in the Disability Committee, and the Disability Committee recommended that the industrial disability retirement be denied. We are truly empathetic to Mr. Fauble. This was a hard case. However, what we agree with the adjudicator's recommendation that his industrial disability retirement should be denied. His retirement was not rendered necessary by his permanent incapacity. He was 2 months away from the end of his drop period, and he voluntarily retired at that point. There was a position, and there was a modified duty or a light duty position that he could have continued on. We had testimony at the hearing from the HR director for the city, for the police department, and everything was consistent with that recommendation. I'd be happy to answer any questions.
We do have two board members in the queue. Tanasi?
So, Mr. Fauble, I want to first of all thank you for your service.
Thank you.
Secondly, these are difficult decisions, and I just want to, for those new members and for people who don't necessarily know, the reason we go through these adjudicator hearings when there's a question of fact is so that you have a formal opportunity to put on all of your evidence, hire an attorney if you want to, do all of those things so that you can get all the time you need to put this stuff in front of an adjudicator. And I was pleased to see that Judge Hoffman was the hearing officer on this case. He's a very well-respected retired judge and a person that I think is an extremely conscientious person in terms of making sure that all the facts come out. There's always the possibility of showing up at a hearing and it goes either way. Being a lawyer, I'm painfully familiar with that. Once or twice, maybe in my career, I might have lost a hearing. I don't know, but maybe. But the point is that the process is there really to help make sure that you get all those facts. And once that happens, because it's a costly process, that recommendation comes back, and at least for me, I have to have a really good reason to ignore the decision by that adjudicator who we've paid, who is a retired judge who comes in and does these things and makes these findings. Right. More importantly, I want to make sure that we clarify, because you're saying you want us to approve your medical disability, and I want to be really clear. You're still getting a benefit. You are getting a retirement pay. What you're not getting, or what you're asking us to do, is to approve a disability retirement, which has some additional tax benefits. So I want to be very clear. It's not that you're not receiving a benefit. I'm sure you didn't mean to imply that, but
Right.
there are some new members on the board, and I want to make sure that they understand it's not that you're going to get nothing if we don't approve it. You're getting your retirement. You're just not getting a disability retirement. And what I want you to also understand, and what's important for everybody on this board to understand, is that it would be great if we could give everybody disability retirement and they could get those tax benefits. If we do that, we jeopardize the plan and the health of the program in general for the other retirees. In fact, the IRS can disqualify the plan. And so it's important that we have a rigorous process, that we go through that process, and that we make the best decision that we can. And so while I'm empathetic with your situation, and I'm sorry that you're the one who's in this situation, I can't vote to approve a disability retirement benefit in light of the fact that there's been a full hearing and that there's been an adjudication decision, and there's a recommendation not to.
Thank you.
Thank you. Tom Sullivan?
I know we have a policy regarding when, I think it's now 1 year after leaving service that you can apply for the disability retirement. And I think when Mr. Fabel retired, it was 3 years. Why do we have that policy?
Are you asking about the policy of timely applying for disability retirement?
If you leave service and 3 years, within the 3-year period, you're deemed disabled, I mean, clearly Mr. Fabel is disabled. We go down through all the questions here, and he is disabled. He could not possibly do the job that he was doing before. So my question is, why do we have a 3-year period? Why doesn't it terminate right at the date that you terminate service?
So you're asking about whether or not the current policy of requiring a member within 2 years of leaving city service to apply for disability retirement. So this doesn't concern Mr. Fabel because his application was timely.
No, I'm just asking, this is just a general question, not specific to Mr. Fabel.
Thank you.
What's the policy between
I just wanted to
having that?
understand. The policy is that as time goes by, evidence becomes stale. So we would like people to apply for the disability retirements timely, such that the records and the documents and the health condition is something that we could evaluate.
Okay. In this one, Mr. Fabel questions whether or not he worked 3 or 4 days in December. He says he was off since October on industrial leave and left 2 months before.
I didn't realize that they had stopped putting money in the bank. I didn't know the state disability was over with. It's called the 4850 plan, I think, and they didn't tell me that they were stopping that payment from the state. So I was at home thinking, what's going on? And then I finally figured out that I didn't have money in the bank that was being put in there directly. And so
no accommodation was provided for
No.
you? You weren't working in a light-duty capacity?
I never worked in a light-duty capacity, ever.
If I could add to that, when the director of HR for the police department came and
Margaret Mendez.
testified, yes, she brought with her records showing that in December, he came back to work for about 3 or 4 days. So there is record that he came back, he went to work. I believe he testified that if he was there, it was in a position where he was doing some sort of light-duty assignment within the department. It might not have been a formal light-duty assignment like the telephone reporting unit, but that he did show up to work and he was allowed to be there. So there is evidence that he went back to work. He was on the clock, if you will, and then he chose to retire right after that, 2 months before the end of his drop period.
In police work, a lot of times after leaving service, a lot of the officers, detectives, et cetera, may go and work to the DA's office. So I would ask Detective Fabel, is that even a remote possibility that you could do a job like that?
No.
So I'm looking at it. The questions that I had was, why did he leave 2 months before? Clearly, he came back 3 days because financial responsibilities and the industrial leave benefit was gone.
Right.
You couldn't do the job. The accommodations weren't being provided, and you couldn't possibly do the job as he is now, and that he wanted to do. I'm just conflicted as to why we have a policy. If this gentleman is in fact disabled, why do we have a policy that allows us to introduce evidence after the fact? He left 2 months before his drop contract was to expire because he couldn't do the job.
I had to financially. I was losing 3 months of pay.
Susan, the accommodations were not provided, or I'm confused. Can you clarify?
We never got to a formal accommodation process for the city in this case because he was going to retire and he was on a modified duty position via his department. So the city, as you may know, has a separate department that addresses reasonable accommodations, generally through like a workers' comp issue. But that's on, the onus is on the applicant to seek that accommodation or their supervisor. This didn't go to that level, but at the same time, if he was in a position where he could have had a desk job or something along those lines within his own department that his supervisor was allowing him to do. So he was on leave, and then his doctor said he can come back for a modified duty. He came back for 4 days, as he testified after he realized his 4850, which is a separate, that has nothing to do with industrial disability as far as the retirement context. And then he left and voluntarily retired 2 months before the expiration of his drop contract.
I had no choice.
Did that answer your question?
So the question that I have, and Detective Fabel has made it, is his benefit that he was getting from the state was no longer being deposited. So he came back, they gave him a 3-day whatever assignment, and then for financial reasons, he chose the option because he had to get paid. And that was the fastest way to pay his bills.
And get things going.
I mean, I'm getting into the weeds a little bit, but what the issue that I have is he couldn't do the job.
Is that something that the doctor would make that decision at that point, and that is not something that occurred? How does that process work? And actually, after you answer, I know Tanasi is in the queue, so.
There's no dispute that he's permanently incapacitated and that he couldn't do his job. But the dispute is whether that incapacity rendered his retirement necessary. He had the end of his drop contract, and that would have rendered his retirement necessary because it was the end of his drop. He also voluntarily chose to leave, and that also renders his retirement necessary because there could have been other positions, either within the department because he went back to work for a few days, or within the city that he could have done during that time. It might not have been on patrol as a police officer, but there were the possibility of other options.
Tanasi, you were in the queue?
Yeah. So just the couple things I want to be really clear about is that as a board, we can either sit and listen to all of the evidence of all of these cases. We absolutely have the right to do that. We can sit down and we can go through all the evidence and we can have the hearing before the entire board and we can spend days going through that process. We made a decision as a board at some point in time that that's not the best use of the board. A, we're not professional adjudicators. B, we don't have the time to devote to hearing each of these cases, and so we have a process, and that process is to go out to a retired judge or an adjudicator who's a professional who's going to listen to all that evidence and to give the applicants all the time they need to go through that process. And so the first question that I'm concerned about is why are we delving into the facts here? And if we're going to do it here, are we going to do it on all of them? Okay, because if I were an applicant that went through the system and didn't like the result, I might very well want to come back here and relitigate my case. And if we are going to do it, we probably need a formal motion for the board to decide that we want to do that in this case, and we want to hear all the facts. The second thing that I want to point out is that this issue tends to become a problem with people who enter drop. And as a reminder, when you enter drop, you are saying, I want to retire. I'm retiring. I'm retiring, but I'm going to go ahead and work an additional 5 years with some additional benefits for me for doing that. But you're stating you're going to retire. And so you made a decision that you're retiring. And at the time that people did that, in the time that Mr. Fabel did that, he wasn't disabled. He entered drop and he was not disabled. Okay? But by the way, these rules stink in some cases. In Mr. Fabel's situation, it's terrible. Okay? But the reality is he retired, entered drop, was allowed to work 5 years. And we always get to the same hiccup, which is, did this disability render his retirement necessary? That's where the hiccup seems to always be. It's rarely a situation of, well, was he disabled or was he not disabled? The question always comes back to, was this disability what rendered his retirement necessary? And it gets complicated even further by, well, what is light duty? Is it available? Is it not available? Did the city do what it's supposed to, not supposed to? And all of those things are factual issues that need to be addressed, and either we can decide them or we can have the adjudicator decide them. We spend a lot of money on these adjudicator hearings, and we spend a lot of money with these professionals to do this, and everybody, both our staff and the applicants, have an opportunity to go through that process, and it's a fair process. So what I want to be really clear about is, I read the evidence. I don't doubt that he's disabled, but that's not the question. The question is, did this disability render his retirement necessary, require him to stop and drop? Because the reality is, had he made it through his drop contract, he was retired. He gets his regular retirement pay. Disability pay has tax benefits, and we've been warned by counsel, both fiduciary counsel and by tax counsel, that if we hand out disability claims, we're going to open up Pandora's box to everybody who would like to have a disability issue. But more importantly, we run the risk of disqualifying the plan. So I just want to be really clear that there's a couple issues. We've gotten into the weeds on this, and I think first and foremost, if we're going to do it, there probably needs to be a motion to hear this as a board and make a new decision, or we need to vote on what has been decided by the adjudicator like we normally do. That's number one. But number two, we need to be careful that we're applying the right standard. And number three, I'm a little concerned because I don't want to hear all of these hearings, all of these cases every time. And if I open it up for Mr. Fabel, I apologize, do I now open myself up to anybody coming back saying, well, now I demand to have a hearing and I think you should hear it because I didn't like the result?
Thank you, Tanasi. We have 3 more speakers in the queue. First, Tom Sullivan. Again, if you have anything you maybe want to add.
So long ago when Tanasi started his statement, I think I forgot it. I go back to the policy that we have in terms of a period of time after leaving service, and Detective Fabel hadn't been getting paid since October, so he learned, and returned to work for 3 days in some capacity. And I don't know if the work was beneath him, if it wasn't sufficient. I don't know what reason he left, but he left. And there was still a period of time, 2 months, that he forfeited in his drop contributions. I don't know what the time frame is, and it doesn't really matter. And apparently it does, though, because that is what is always, as Tanasi calls it, the hiccup. But it's clear to me that an industrial disability, the job rendered him in the condition that he's in now. And if he wanted to go work for the DA's office and do anything that what he was trained to do, he couldn't. So that's it.
Thank you, Tom. We have Johnny Tran.
Thank you. I just wanted to help clarify the understanding of the adjudicator's role in this process. So you are the ultimate decider of this. You should not rubber stamp anything the adjudicator says. You send these out to hearing to ask for expert advice on weighing these issues. They're medical issues, there's factual determinations. But they come back to you as a recommendation only. So please don't feel that you have to always rubber stamp it. If you have a question about what the adjudicator says or even doubt, you could send it back to the adjudicator for clarification. You could ultimately disagree with the adjudicator and decide otherwise. So I hope that clarifies what the role of the adjudicator is in this. I also want to point out or discuss the issue with Mr. Falbell's finding that he cannot be a police detective and why he wouldn't be eligible under the adjudicator's recommendation for this disability retirement. The law is that you just have to do your old job. He can't be a police detective according to the adjudicator. The law is if he can't do a modified position either. And the issue in this case is Mr. Falbell was forced to leave 2 months later after he actually left because his drop agreement required him to do so. So the adjudicator is evaluating whether or not Mr. Falbell could have worked 2 additional months in a modified capacity, not as a full police detective, and if the city of San Diego made that position available to him. So that's what the adjudicator is deciding at that point, and his conclusion was that he could have kept working those 2 months. There are notes in there that says his opinion may have differed had Mr. Falbell left earlier in his career because of his condition, or if drop did not exist, and such that Mr. Falbell would continue working longer than 2 months. So please take those into consideration when making your decision.
Thank you, Johnny. We have Val in the queue.
All right, so I've listened to what everybody's had to say, and I think Tom's point was that Detective Falbell was so disabled at the end of 2013 that he was incapable of performing any light-duty position that may have been available to him at that time in November, December of 2013. I understand that. And I think Tanasi's position is that the adjudicator, a respected retired Superior Court judge, considered all of the evidence, including the testimony of the San Diego Police Department HR manager and 2 medical doctors who examined Detective Falbell, one in 2013 and one in 2016, and that the case really turns on the factual finding of Judge Hoffman that SDCERS carried the burden of proving that there was a light-duty position that Mr. Falbell could have performed at that time. At this point, I would be welcome reopening the evidentiary record if we were presented with any new evidence that wasn't considered at the hearing and that could be presented now, or if we were advised of any evidence presented at the hearing that Judge Hoffman failed to adequately consider and weigh. If either of those things were true, I would like to reopen the record. But as of right now, I haven't heard either of those 2 things. And without any new evidence or any plausible argument that Judge Hoffman booted it because he didn't consider something that was evidence at the hearing, I don't know how this committee could reach a different result.
Tom?
I think the only one that can provide that information, and Detective Falbell represented himself during this hearing.
Right.
And he alluded to it at the very beginning of his presentation today about the addiction. And I suspect with him that there might be other issues that have arisen over the last couple of years with him that may justify having a second look. And I can only ask Mr. Detective Falbell if he wanted to try and present that, or not.
Yes.
The fact that Mr. Falbell represented himself and may not be in the best position to be his own advocate at that hearing, and that it's expensive to hire legal help to present cases like this, is the hardest thing about this case.
Tanasi?
For what it's worth, if Mr. Falbell believes that there's some new facts and he wants to go back to the adjudicator, and even if he wants to hire an attorney at this point in time and take those new facts in front of Judge Hoffman to reconsider, I would be okay with that. What I'm not okay with is hearing that evidence here on this case or any case unless that's going to be a board policy or decision going forward. So, I mean, I would say, and it's not it's really, I guess what it would be is we would not vote on this. We would kick it down the road if that's what Mr. Fabel wants to do and allow him to go back with that new evidence. Not a whole new hearing, but hey, this is the new evidence. This is what you need to consider. Have it, if he wants to lawyer up, I don't have a problem with that. So,
Johnny, do you have any comments on that process then? I mean, if we put it back on Detective Fabel to then go back and present new evidence to the adjudicator, is there anything we need to consider for that?
I don't. You would just need a first, second, and agreement by the board.
Could I ask a question? What is the financial impact of going one way versus the other? Because I don't know whether this merits, in Detective Fabel's case, spending money on a lawyer, whether it doesn't. I guess that's not my decision to make, but I'm still curious about the information.
Sure. To the industrial disability retirement would be treated by IRS for tax purposes as the same way as a personal injury or workers' comp injury. So to the extent his service retirement, which he's receiving now, covers that, the disability retirement covers that, that would be tax-free.
So the whole pension would be tax-free versus taxable?
Not
Or some
all of
percentage?
it. Not all of it, but a percentage of it would be, when otherwise it would not be. It would just be income as a retiree.
Do we have any estimate of that percentage? I'm just curious.
I'm going to let the number of people speak.
If we don't, that's fine.
So I can't answer to the, is that on? Can't answer to the specifics of Detective Fabel's case, but in an industrial disability, currently for the class of membership that Detective Fabel is in, the first 50% of his final average salary would be treated as tax-free, and the COLA payments associated to that would be also treated as tax-free. I don't know the specifics of his case, but it does appear that he entered drop at age 50, which means he had to have at least 20 years of service. So that would have given him, at minimum, a 60% benefit. So 50% of that would be, up to 50% is tax-free, and that additional 10% to get him to 60% would not be tax-free. 13th check is also not tax-free, but I don't know the specifics of where this would fall.
Thank you, Marcel.
Thank you. We have Karina in the queue.
Yes, so I just would like to understand from General Counsel that we would be able to make a stay on the decision and request a clarification from the adjudicator for the evidence that indeed there was modified light duty provided.
That's correct. You could send it back to the adjudicator. The finding is that the modified duty was available. I think the issue that Val was speaking of is, was there additional evidence that wasn't considered or any other reconsideration of the item? But to get to your point, you could send it back to the adjudicator for any number of reasons.
We have Roberta in the queue.
The finding of the adjudicator was, and this is on page 7, line 18. However, as discussed previously, Fabel was placed on modified duty with work restrictions or light duty between 2000 and 2013 prior to his retirement on January 4, 2014. There's a little more specifics above, but he made that finding.
Roberta.
It's my understanding there's a difference in the calculation of the benefit if it's an industrial disability benefit or a service-related benefit. Is that true?
Yes.
Yes. So what is the difference to Mr. Fabel if he, in dollars and cents, if he receives a service disability or a service retirement or a disability retirement?
In Detective Fabel's case, there is no difference in the gross value of his benefit because he was eligible to service retire, and his service retirement is a higher benefit than a disability retirement. Had Detective Fabel not been eligible to retire and was disability retired, then he would receive a benefit of 50% of his final average salary. But he was eligible to retire, and he is receiving a current benefit of greater than 50% of his final average salary. The only difference is in the taxability of it, but the gross dollars paid to him are no different in his case whether he receives an industrial disability benefit or a service retirement benefit.
Actually, what you just said was that the disability benefit is 50% of pay, and his service-related retirement would be some 60% of pay, right?
I don't know his specifics, but based on the facts I see in front of me, his service retirement would have been at least 60% of his pay. But what happens then, if he's awarded a disability benefit, then when we go to report that information to the IRS, we take the equivalent of what 50% of his final average salary would have been and report that as tax-free. And the additional benefit he's receiving by virtue of being eligible to service retire would be fully taxable.
I have one more question. I think there's a difference in modified work being available and modified work being presented to him. So I haven't heard the answer to that.
Susan, can you?
Well, he was working in a modified position and when he went back, whether that was an actual classification of a modified duty or a light duty position. Modified work was not presented in that with the reasonable accommodation office through the city. The applicant has to seek some sort of position and go through that process. He never went through that process. So if there was a modified position available to him somewhere else in the city, we don't know about it because that wasn't included as part of the process.
Tanasi?
In other words, he was being accommodated informally, so he didn't have to go ask for it because his department was doing that. But if his department had denied him, had said, no, we don't have a position, we're not going to do it, he then could go over to the department and seek to formally get a modified duty position. Is that correct?
Correct.
Okay.
Val?
All right, so I think what I may have heard that might be new evidence, and Tom, I think, has brought it back up, is that it's possible that Detective Fabel was being influenced by the medication, may even have been a temporary addiction to pain medications or other medications that were prescribed to him as a result of the work-related injuries. And if that were the case, he would not have been capable of performing a job, even if he had been physically capable as a result of the medications. I didn't see enough discussion in the judge's opinion to make me comfortable that all of the evidence on that point was adequately brought out and considered. Do you want to comment on that, Susan?
I do. So I don't know, I don't feel at liberty to discuss all of his medical issues, but at the same time, he has a number of issues that aren't work-related. All the evidence came in. We had a very robust hearing. It was about 6 hours. There's over 100 exhibits within the joint exhibit binder. He brought in additional medical records at that time. The judge heard from our doctor, as well as the Margaret Mendez, the police department HR manager. And I think that including the medication was discussed as well. Everything came in and was looked at by Judge Hoffman. I don't know if that answers your question or if you'd like me to talk about further.
Do you believe it was a full and fair airing of all of those issues where Mr. Fabel was able to adequately present the evidence and the evidence was considered?
Yes, despite the fact that I understand that this can be difficult for people who don't have attorneys.
Right.
We worked in conjunction with him. We afforded him every opportunity to discuss everything in his own time frame, and it was a very, I would say, not as informal proceeding in the fact that he was allowed to do and say whatever made him comfortable to feel that all the evidence came forward.
So let me ask Mr. Fabel, do you feel you were given an adequate opportunity to present all of the evidence that you might have regarding your disability, including any addictions to pain medications or other things that were a secondary result of the injuries?
I believe so.
All right.
Are there any other questions?
So we do have a motion to approve the adjudicator's recommendation to deny the industrial disability retirement application. Should we move ahead with that current motion? And I know there's been talk of another motion, but should we move and vote on this one first? Is that?
Yes, as the chair, you could move it.
Okay, let's go ahead and move this item.
Ready to vote? All votes are in.
That passes 9-3, and thank you very much for coming today, and we're very sorry to hear your circumstances, Detective Fabel. So,
Thank you.
with that, we have a disability status report. Really, things have slowed down quite a bit. I know we had many applications in the beginning of the year, but now we're evening out, so things are looking to be on track with the amount of cases that we're having through disability. And with that, I don't think if anyone has any other comments or questions, that concludes my report.
Yes, sir, Mr.
We
Hovey.
have business and governance training in closed session left. Given that we anticipated running a little bit longer, we do have lunch. If you were inclined to take a break, you could do that now, or the lunch is a cold lunch. You can wait until later to take that.
I'll take a show of hands.
His stomach's growling.
I don't know why zero was that close, but yeah.
We have enough people that want to take a break. I think at this point, why don't we adjourn to take our lunch break, and we'll come back in 20 minutes? All right. And then, as soon as Mr. McBride takes his seat. All right, Carol, you guys ready? Ready to go? All right, we're gonna go back into session for the Business and Governance Committee report, which I'll give. First item under Business and Governance is the approval of the consent agenda items 1 through 8. I'm going to ask that we pull, I think it's items 2 and 5. Yeah, 2 and 5. And move approval of the other 6 items, which are in your materials. By the way, all these carried unanimously, and I should have also pointed out that to new members that the Business and Governance Committee meetings are actually on closed circuit TV, like our meetings here, and I think you can access those on the website if you want to review those meetings, which go into more detail about all these items that we put on the consent agenda the next day.
On the website anytime, and we also have a YouTube channel, which is all high def. So anytime you can watch them on YouTube. Tell your friends and neighbors.
So if you're suffering from insomnia. All right. So then we'll separately consider first, I think, item 2, staff's recommendation to revise the
We're
conflict.
waiting for one more vote.
Oh, I'm sorry.
Okay, got it.
All right. So the motion carried unanimously. And that brings us then to item 2, which was staff's recommendation to revise the conflict of interest policy in Johnny Tran. There were some slight modifications, which is why this was pulled.
Yeah, thank you. Both the B&G and the B&G committee voted to pass this with some wording changes to paragraph 7 that relate to wearing the one hat rule that we talked about. So I had given you a printout of what my understanding was, but I'm going to read you the changes that were made by the committee. And so
Is that because your understanding was wrong?
because I misinterpreted a few words. But let me read this to you, and this will what you'll be voting on in addition to the revisions that were presented to you as part of your board material. Paragraph 7, interest in trustee's constituency. A trustee's interest in a constituency that elected or appointed that trustee may cause a conflict of interest on a particular matter. If a trustee believes that an interest of the constituency that has appointed or elected the trustee may create a conflict, the trustee is encouraged to seek legal advice before participating in the discussion, vote, or contracted issue. Trustees should recognize at all times that the trustee's fiduciary obligation is to act in the best interest of the system and its members as a whole, and not to a particular constituency that elected or appointed that trustee. With that, you can move it into consent.
Great. That revised language was approved by the Business and Governance Committee unanimously yesterday. And then Johnny made those revisions. And so I'll move approval.
No, Carol, that was my understanding of what it was, and then Val, who made the motion yesterday, clarified some added language. So that's why I read it to you.
There's what we call a
apologize.
scrivener's error in the board material that you received.
Ready to vote? All votes are in.
All right, so that motion also carries unanimously. That brings us to number 5. I pulled that because we have a speaker slip from Anna Martinez, who has patiently waited all morning for us to get to this item. Before we present this item, and I'm going to go in the same order that I usually do, first to Ms. Youngflesh, then to Ms. Martinez, but before that, one of our trustees has asked for permission to speak, so Mr. Hogquist.
Good afternoon. I just wanted to make sure that everybody knew that a couple of weeks ago, Anna called me at home, and we did have a discussion about her case, and I encouraged her to file her appeal and gave her some language to use. I just wanted everybody to be aware of that so that we had full disclosure.
Thank you very
Charlie,
much.
for that. Thank you. I asked Charlie to do that pursuant to ex parte communications. Anytime you have a hearing in front of this board, we want those conversations to be public. And so to the extent you had a private conversation, that's something we want to avoid. But if it happens in the case where Charlie just picked up the phone, in that case, that you would disclose it publicly. So thank you very much, Charlie.
All righty. So, Ms. Youngflish.
So as we discussed yesterday, Anna Martinez is a general city member that retired from DROP. She qualified for an exception under the 90% cap provisions. The city enacted the 90% cap provisions in 2002. Pursuant to that, her retirement factor should have been frozen as of December 31st, 2002. However, staff incorrectly applied the factors that were in effect in excuse me, June 2003 when she entered DROP. This caused her benefit to be overpaid by $42,000. In 2010, staff identified the error, but a full analysis wasn't completed until 2016. Because of the delay, staff went to the board in March of 2016 and asked the board to waive the interest of $13,000, and the board agreed to do so. She now owes the principal of $42,000 and associated interest of $700. She appeals her benefit correction in the entirety. Should also note that in March of 2016, her benefit was corrected prospectively and reduced from $10,000 a month to $9,800 per month. The courts have consistently held that this board has the authority to recoup overpayments with interest. The board has a fiduciary duty to the membership as a whole and a duty to maintain the financial integrity of the system. So staff would ask that the board deny Ms. Martinez's appeal.
All right. Ms. Martinez, the floor is yours.
Thank you very much. I appreciate the opportunity to speak because at the hearing yesterday, I forgot to ask a question from the staff report, and that is that it's really a major concern for me, is that the error was found by the SDCERS staff on 6/30/10, and it seems like there was an unreasonable delay in notifying me of this information, and I was wondering if you could explain to me why there was such a long delay.
Ms. Martinez, that's actually not, I think, an appropriate thing to do. This is your opportunity to present your argument for your appeal, but it's not a question and answer.
Okay, so all right, so my understanding, though, was that I could have filed something to the staff person prior to the hearing yesterday. Unfortunately, I did not understand that I could do that, and then the staff person would have responded to my questions. So that's why I was asking. So if it's not appropriate, then I'll... Is there some other way that I can get an answer to that question?
I'm going to defer to counsel.
Val, I agree with you that this is an question-answer, but the trustees are free to ask questions to staff if they have questions.
All right. So would any trustee like to take Ms. Martinez's question to staff? Sure.
For whatever it's worth, my understanding is that there were administrative issues that were going on that prevented the full analysis, and there was a whole slew of issues that were discussed, and the board was concerned with the delay, which is one of the reasons why they agreed to waive all the interest, not only for you, but people who were in your situation. And I think that the good news is that staff has gone over and above to try to ensure that this doesn't happen again. We've spent an obscene amount of money on software to make sure these things don't happen again. So I apologize that you, on behalf of the board, on behalf of staff, I apologize that you were in that situation, but it wasn't just unavoidable.
Okay, and one of the reasons that I have come down here was that I don't want this to happen to another employee. This is like the second time that I've gotten caught up in this web of errors, so I appreciate that.
And that's our primary concern, which is why we have gone to the trouble of going through with a software conversion and a number of other things. So I absolutely appreciate and empathize with you on that. So.
Could I make then one other comment, and I'll be brief. I did want to mention that I did find some additional information. I had talked about the center, the Pension Rights Center, and they talk about an overpayment calculation should be limited to a three-year look back. And someone happened to mention to me that the California Civil Code of Procedures, Section 355, somebody help me out, Section D, anyway, has a 3-year statute of limitations as well. So I was happy to see that. I'm sorry, it's 338 subdivision D has that same 3-year look back. So, and that concludes my comments.
Thank you, Ms. Martinez. I think the board has, on previous occasions, dealt with the issue of statute of limitations and the look-back period, and we've had extensive discussions of that. For new members of the board, I'll invite either Ms. Youngflesh or Mr. Tran to address the statute of limitations issue and how it applies when we're dealing with offsets against future benefits. And so we've gone through extensive discussion and review of that issue before in other cases. And I also want to echo Tanasi's comments, and we'll hear more from that about that from Marcel, who's on the agenda, and you're welcome to stick around because she's. I'm going to ask her to address the same question I did yesterday about IRIS and its impact on the future incidence of these kinds of miscalculations of benefits, which unfortunately are a reality of human error, but apparently machines do a better job than humans do. And so, as Tanasi says, the members and the fund have made substantial investments to prevent this from happening again. So, Susan?
Thank you. The code that she's referring to is only applicable in a judicial proceeding and not to administrative boards. The courts have consistently upheld that. And if Johnny would have anything you'd like to add?
I'd like to remind the board that we went to trial on this issue, and the finding of the judge was that the statute of limitation did not apply to the administrative correction of this.
Right.
For certainly, prospectively, you have a duty to give the right benefit. And so if you found the error, and we were not prevented from collecting the overpayment made in that case as well.
And that was one of the lawsuits that's, I think, within the last 5 years that's been decided.
I was tried last year, and it's on appeal right now.
Yeah. All right. I don't see anyone else in the queue. This was carried unanimously yesterday, so I think if I make the motion, no second is required. So I'll make the motion to approve staff's recommendation.
Ready to vote? All votes are in.
All right, that carries unanimously. Thank you very much, Ms. Martinez. I appreciate your patience.
Thank you.
All right. So that takes care of the action items. And I know one of our trustees may have to depart early, but there no more votes on business and governance. We'll just go through new business, and all this is available on the video of yesterday's meeting. So the first one is the discussion regarding the internal auditor's reports on cost of living annuity and surviving spouse annuity. That was given by Marcel Rossman and Johnny Tran. Marcel presented staff opinions on the internal auditor's recommendations to the board in his cost of living annuity and surviving spouse annuity reports, and there was no action taken on that item. There was a separate related action item that was approved on the consent agenda a moment ago. Item 2 was Jessica Packard's presentation or update on the trustee elections, the results from the March election. The current active general trustees, Tom Battaglia and Jeffrey Wallace, were reelected. Michael McBride was elected as the fire safety trustee, and welcome to the board. Next item, item 3, was a discussion regarding training opportunities and possible ways to reduce costs. Johnny will go ahead and do a summary of that presentation for us now.
Thank you. Very quickly, the committee yesterday discussed the in-house training opportunities and also the external training education courses that you take and possible ways to reduce the costs. Overall, the committee was very supportive of the trustees continuing to take education courses, but to be mindful that if there are cheaper alternatives, to look at those courses. As you know, Mark Hovey works with each of you to personalize some recommended classes to you. Many of those courses are in California, which would reduce travel costs. Another point that the committee wanted to make was to stress that each of your travel requests require approval by the board. And so when those come up, to be mindful of that and to not rubber stamp it, but to question if this training is necessary, if it's appropriate, and not just push it through. Anything else?
So the idea here is we're not going to cut back on good training, but every request needs to be analyzed in terms of whether it is a reasonable expense or whether there are alternatives that are less expensive. All right. Thank you, Johnny. That gets us into old business, and this is the action item that I noted a moment ago, where I actually would like Marcelle to come up and speak on this as she did yesterday, even though usually I would just summarize it. I think in light of Ms. Martinez's presentation, it would make sense for the whole board to hear this.
Thank you. So in my presentation, I want to give a little bit of background for our newer trustees. We do have a board policy that requires me to bring forward to the board any corrections to members of greater than $10,000, and then to come back to you and let you know the resolution. Over my time here, that report has been getting smaller and smaller. There was one new member on the report this year. That was not due to a staff error of someone at SDCERS. It was an issue with them not getting timely enrolled into the defined benefit plan, and we worked very closely with the city to resolve that issue for the member. They do owe us a substantial amount, about $18,000 in contributions. They do have the ability to transfer the monies that they've paid into the defined contribution plan at the city over to SDCERS to help cover the cost, but it won't cover the full cost. There were 3 members that were still working to resolve. One of them was Ms. Martinez, which you've heard today. One of them was Ms. Toomey, which you also heard today, and then a 3rd member we're working with. So where this ended up was down to 1 outstanding case, or actually 2 outstanding cases over 10,000, which has been going down significantly. Our new system.
We used to get, a few years ago, we would get long lists of people with corrections over 10,000.
Correct. And so when we implemented IRIS, what we did was we automated a lot of the process of calculating someone's benefit, which had been more of a manual process earlier. Our previous system, Pension Gold, did do some of the calculations for us, but not all that we needed. So a lot of the errors that we have had that have resulted in corrections are old errors. They are from long before we implemented the current system. When we went to implement the system, we did a full review of all of our members' accounts, and we came up with a list of members that potentially had issues when we compared the data from our new system to our old system. We prioritized those and looked at ones that, that we primarily felt would have a financial impact on members, and we completed that review June 30 of last year. The remaining ones were more demographic issues, and we are on target to complete that June 30th of this year. At that point, we feel like we're starting with a pretty clean slate to go forward, and I anticipate having very few corrections coming before this board.
All right. Thank you very much, Marcelle. That takes us to the status report section, staff reports by division. Legal and compliance was Johnny Tran. He presented his report. He didn't find any problems with the Statement of Economic Interest Form 700 annual filings, thankfully. He also discussed the April 2017 Court of Appeal ruling in City of San Diego versus the Public Employees Employment Relations Board, PERB, which found that PERB had erred when it concluded that the City of San Diego violated the unfair labor practices by failing to meet and confer over Prop B. We also received a report from David Bond on information technology after feedback from our October 2016 disaster recovery exercise was incorporated into the SDCERS business continuity plan. Staff felt it prudent to conduct a second simulated disaster recovery event in March, which was led by Michelle Wagner-Malecki, who I think is pronounced a superstar. Issues from October 2016 from that exercise were ironed out, and the March dry run was successfully, disaster recovery, was successfully conducted from end to end.
Next, we heard from Cynthia Queen on member services. She presented the new online service debuting on SDCERS website next month, which will enable members to submit retirement applications via the secure member portal prior to attending a personal counseling session. This streamlined process will make our core business more accurate and efficient, eliminating the need for duplicate manual data entry. And Cynthia fielded a lot of questions about that. If any trustees have questions about that, we can certainly ask them. There are a number that are on video.
I have a question about member services. Because I'm not part of your committee, how's the phone calls and the responses? Like, we haven't heard about.
Glad you asked.
Haven't heard for a while.
Thank you
Now the
so
meeting's
much
gonna
for
run a lot longer
asking.
Quickly.
Our goal time is to always be under 20 seconds. We have consistently been under 15 seconds, and for these first 12 days in May, the wait time has been 11 seconds.
Oh, wow, thank you.
You may find buried in your board materials, there's a graph that shows the wait times compared to goal over a period of months. And it is a asymptotic curve. I don't know, but it's going down, and it's approaching zero. So very, very good work at the call center.
Is that with the same amount of staff, or you increase staff for technology, or?
Same amount of staff, just
Great.
very well trained and excellent supervisor
you.
in Shawnquanah Pemberton.
Next, we had a benefits administration report from Marcel, who pointed out that there was only one outstanding PSC request in each of the last 2 months, which is a significant improvement from when there were when there was a 6-month or longer wait. Staff updated the City of San Diego Retirees Health Enrollment Booklet, reducing the size by 20 pages without losing any information. Thank you. And then Finance, Ted LaSalvia gave his report. Usually Ted comes up and does it again, but in the interest of time, I think we'll blow by that. You can all watch TV and see how it went. Ted reported that that Finance is current with financial reporting through March 31, 2017, and has recently presented the board-approved fiscal year 2018 budget to the San Diego City Council. It was a very positive report. Ted also presented the February and March 2017 trust financial statements. As of March 31, 2017, SDCERS had a net position of $7.3 billion and total investments of $7.3 billion. For the 9 months ended March 31, SDCERS had an increase in planned net position of $459 million, reflecting net investment income of $577 million, contributions of $262 million, and total expenses of $380 million. Is that all good, Ted? All right. Obviously, this is influenced by a very positive investment return period, for which we're very thankful. Then, March 2017 year-to-date expenses and capital expenditures, actuals versus budget, were presented by Ted. Administrative expenses totaling $34.1 million for the 9 months ended March 31, 2017, were 3.3% under budget. The budget was $35.2 million. Information technology, legal, general operations, and investment management fees were all under budget. And I think that concludes business and governance. Yes. So, with that, we move on to non-docket items or comment? Training. Okay. Johnny.
Thank you, Val. We have a few training requests by our 3 new trustees. Because it's so long, I'm not going to have Cynthia type them in. I'm going to read them to you. Michael McBride, George Kenny, and Roberta Spoon would like to attend the Calipers Principle of Pension Management August 28th at Malibu, California. Ms. Spoon would like to also attend the IFEPB 63rd Annual Benefits Conference in October in Las Vegas. And Mr. Kenny would like to attend the following 4 conferences: PIMCO Institute on June 13th in Newport Beach, Wharton Advanced Investment Management September 25th in Philadelphia, the Trustees Masters Program in October in Las Vegas, and Invesco Conference in November in La Jolla.
All right. So any comments or thoughts under our new policy?
Under your new policy, Mr. Kenny will meet his 4. Being a new trustee, he actually doesn't have a
good
limit of 4.
Right.
But given he is new to the investment committee and he is definitely focused on investments in those 5 courses he'll be taking this fiscal year and 4 next.
Great. All right, so we need a motion. Motion's been made by Tanasi Priovalos, the second provided by Jeff Wallace.
Ready to vote? All votes are in.
All right, motion carries unanimously. Now we're into questions and comments from president, trustees, and staff. Mark, anything?
Nothing.
I recommend on the committee level and the board level that we start using the clock for presentations, because for you let some people talk, they can go on for a long time. Yesterday, investments, we had presentations going on past 30 minutes, and not to cap them, but just ask how long do you need. If they say 20 minutes, whatever tools we have to say, okay, here's your 20 minutes. I've noticed that there's
I've heard about this, but it seems to me that the problem exists primarily at the investment committee level.
Oh.
Maybe I'm wrong, but I think the investment committee meetings are the ones that tend to go on the longest. And I'm not saying it's a problem. I've just heard that there have been some marathon meetings lately.
Well, I'm not on that committee, and I feel totally singled out by Jeff's comment, and so I just want to.
Yes,
Make it the Tanasi
we can
rule.
muzzle Tanasi, but I really view that as the discretion of the committee chair, and I think that may be a point that should be addressed to the chair of the committee, where there may be some lengthy presentations that could be shortened. At least that's my view.
Thanks for the comment, Jeff. Liza and I do talk about how long the investment committee meeting is going to go, and generally how long their presentations will last. We do the same at the full board meeting, so we're aware of it. We could potentially do a better job communicating with investment committee members on how long the meeting is going to run. For example, yesterday, we were pretty much assured that it was going to run till 4:30 or 5, so that was not a surprise to us. But if it wasn't clear to you coming in that it was going to run that long, that's certainly on me. I want to make sure that you know how long it's going to run. It is true that we do give our presenters suggestions and guidelines for how long they should take, and some of them take longer than that. So to Val's point, I do think that's partly a responsibility of the investment committee chair, and I will certainly work with committee chairs regardless of where they're at to ensure that you feel comfortable interrupting a presenter if you think they're running long.
That satisfactory, Jeffrey?
Sure. I just thought it would be on running a meeting, running all these, for whatever, when we're working with, if there's consistency on how we ran the meetings, then it would be beneficial, or more efficient, I should say.
The other thing that we could do is provide you with a button where you could turn off the microphones. And Tanasi's microphone would be on that list.
They're right here. I want to apologize for any of them.
All right, thank you, Jeffrey, for those comments. And we will try to be guided by those on our investment committee in the future and keep things. It was a couple of months ago that I think the meeting was surprisingly long, not this last one.
Occasionally, they do run longer than we expect. Yesterday, that was not the case. It went about as long as we expected, but your point's well made, so thank you. I'll talk that over with Liza.
All right, so Michael McBride is in the queue.
Just wanted to thank everyone on the board for a warm welcome, and staff for the support given prior to these meetings and along the way here. And I appreciate the work that you've all done on the behalf of members prior to me coming on board.
Thank you. Well said. That, I think, brings us to non-docket items, of which. Oh, I'm sorry.
I noticed there's about a half a tree of paper in the back, and if there was another option that we could do to suffice the printouts for other people that are coming in here.
There's an old settlement that SDCERS entered into that requires us to do some printouts in the back. So we do recycle those, Tom, and we do our best. So I'm not ready to pull those yet.
Well, and I understand that we have to have some back there. Do we have to have that many? Is there a certain amount that we have to provide? Because it does cost a lot of money to recycle that back into a new piece of paper.
Excellent point. Let me work with staff to try to get the right amount, okay? Thanks.
All right. Nobody's in the queue, so we're on to non-docket items, of which there are none. And so I think at this point, we should adjourn into closed session.
Hey, John, we reduced the paper cost. Can we find the chips for lunch too? Will we have the money for that? I'm just curious. Yeah. Okay. All right.
Here are the liabilities for all of these contracts. And if your pricing is a one-size-fits-all, the fact of it is that this is the liability associated with all those contracts. Some people should have paid less.
Do we
some
have,
people should
do we have
paid more, but that's the
televisions rolling and everything?
Now, CJ will come back and give
So
you the
Conger looked at this and he said, but these people down here, they overpaid.
Raise the rate.
Because you're already saying that price, the one-size-fits-all is more than you needed. But it's like, well, yeah, but all these people overpaid. And he's cherry picking something about how you would value the liability, but we have, as Dave said, plenary authority to do pricing is one-size-fits-all.
Joan Lewis will never understand this.
That's what we did.
All right. And this was for the, which rates?
Well, anyway.
Raise the actuary for purchase service.
Oh.
It's just really stupid. I mean, we won on demur the first time because the judge got it. It was like a bogus claim. The Court of Appeal just had a brain cramp when they sent this back to the.
What I didn't say is that I'm on Judge Lewis's permanent recusal list
At least argued.
because of our personal relationship. We're social, we're good friends.
Okay.
How's Jane?
Margot and Lewis.
I'm not concerned about friends.
So she was a witness at my wedding. So,
More than they needed. More hate. Mike's got 118.
Ready when you are, Val.
all righty.
Out here, he doesn't even know if his he doesn't know if his client's part of.
All right, so we're back in session to report out the results of the closed session part of our meeting. Before we adjourn, I have 4 things to report. First, the board has agreed to settle the securities matter of Sullivan versus Barclays PLC. Second, the board has agreed to file a securities action against Tesco PLC and will execute agreements with litigation counsel, Stewart's Law, and funding entity Bentham. Both of those items were approved unanimously. Third item is that in the purchase of service credit litigation matters, the board agreed to waive the official information and deliberative process privileges for 2 documents related to actuarial services provided by Chiron, and further that the waiver would extend to a scope that would be fair and reasonable with respect to those documents and the subject matter of those, and that'll be provided by outside litigation counsel in consultation with our legal staff and Mark Hobie. And then fourth, the board authorized the chief executive officer, which is Mark, in his discretion, to waive the official information and deliberative process privilege as to other documents beyond just those 2, and this is the scope I'm talking about, based upon the joint recommendation of SDCERS, General Counsel, and Litigation Counsel, and a member of the board will be consulted regarding that decision and provided with whatever information is necessary to participate. And those were also 9-0 votes. Okay? So with that, I will adjourn the meeting.